McKee fired up to give you the data, and he's told me what matters is the wage dynamic, and it's going to be interesting. John, I know you want to talk here about what we're going to see.
Well, I want to talk about what we're expecting, Tom. 189,000. Big banks out with their estimates. Citi top of the pile. Look at this for a number, Tom. 305,000.
Whoa, did not know that.
From Citi. Then you've got Morgan Stanley, JP, Evercore, all looking for something around 175K.
Yeah.
But Citi pretty punchy out there with 305K this morning.
We get briefed by someone with one of our great insights of 2022. Sarah House, a senior economist at Wells Fargo. We'll talk about the last mile in a moment. Sarah, I've got to go to the jobs report today and see a survey of average hourly earnings coming in. What are the ramifications to you and Wells Fargo if we get a more quiescent inflation growth of average hourly earnings?
So I think if we get a softer average hourly earnings print, that's really going to increase these soft landing prospects that we've already seen, I think, pick up a little bit here recently, given that the Fed is still hyper-focused on inflation, but particularly that inflationary element coming from the labor market. If we see further softening there,
Sarah, if we see that, should I buy Google?
I'll leave that up to our equity analysts in terms of what
Continue on wage disinflation. What is your call?
So I think we'll see some moderation further ahead as we get further past the extremes of the reopening, the job reshuffling that we've seen, but I still think it remains to be seen how quickly, if at all, we get back to levels that I think the Fed will deem consistent with their 2% inflation goal. So ultimately, we're still looking at an incredibly tight labor market. So we see it with the unemployment rate, we see it with the still very low level of jobless claims, and so it goes back to that idea of, we've made a lot of progress here, but getting that last little bit of inflation wrung out is going to be the hardest and likely the most painful part of the labor market process and correction, which could ultimately lead to job losses.
John did a great job outlining how there was new information at the Fed and the ECB meetings this week, that they seemed to shift their tone to perhaps seeing that the risks were more balanced, doing too much or doing too little. Have you shifted your view of the response function of central banks, that we are now fully past the peak tightening phase and heading into a rapidly approaching easing cycle?
I think we have seen the Fed get more constructive on the outlook. So we saw that with the multiple mentions of the disinflationary process starting and that acknowledgement there. I think they're still very guarded, just given, one, the fact that inflation still remains too high, and that they have been fooled once by how quickly inflation would come down. So I think we're seeing the Fed trying to keep its optionality open. But I think all else equal, we have seen a tilt towards maybe a little bit less tightening and again, maybe slightly higher prospects of pulling off that soft landing.
What kind of numbers, particularly when it comes to employment, would shock this market, would shock you in terms of your understanding of how quickly things were disinflating?
Well, we've seen the jobs numbers come down pretty gradually here over the back half of the year. Now, we're going to get some of the benchmark revisions, some new seasonals, so that might alter the most recent path and momentum. But in terms of what I think would really have to get the Fed's attention and maybe make them start to sweat a little bit, it's probably somewhere below 100,000. So if you look at just the supply dynamics, we really probably even need less than that to just keep the unemployment rate constant. So there is altitude to lose before I think the Fed gets really worried about the state of the jobs market.
How do you explain claims? I think I can speak, Sarah House, for Mr. McKee and say we've never seen it. How do you explain, for example, Drew Mattis at MetLife finds weekly data like claims to be important? Okay, great. How do you explain something I've never seen?
So I think it does speak to the fact that ultimately we are in still a very tight supply spot, and so businesses are very cautious to lay off workers on net. So sure, we've seen a lot of big household names announce layoffs, but overall we're still looking at a very low level of layoffs. So if you look at the JOLTS data, that also shows that layoffs remain historically low. And with the claims number, some of that might be a little bit influenced by some of the difficult seasonals we have this time of year, the fact that maybe some recently laid off employees might not be filing because they would forego their severance. But I think overall, even if you look through that volatility, they're still pointing to what is still a very strong jobs market.
Last year, Sarah, people were talking about the improbability of a soft landing and how basically this was threading a needle that was virtually impossible for the Federal Reserve, that had never been done before. Now we're looking at a probable soft landing that's getting priced into the market. What's your probability and how has it shifted of a soft landing?
Yeah, so we still think that a recession is more likely than not here. So we're expecting that we'll probably see some of that broader widespread weakness in the back half of the year, although we could be looking at a negative GDP print here in the first quarter. But I think so much of this comes down to the fact that we're still that there's still issues on the supply front when it comes to labor, and that's going to be a huge key to this soft landing prospect, where not only are you getting the goods disinflation, the housing disinflation, but whether we get those wage pressures coming down in the benign way where you have employers able to fill positions but not have the cost pressure of it so great, and then you have consumers getting a paycheck and going out and spending and propping up demand for other businesses.
Hey, Sarah, this was great. As it always is, Sarah House there of Wells Fargo, calling that term at the back end of last year, the final mile of the inflation push, and how much harder that might be, Tom, once you get down to something like 4.
Yeah, she codified that. I mean, there's some real, we have Priya Misra coming up on the curve inversion as well. You've got eyes in the tech optimism coming out of the where they were. But, you know, it goes to cable TV and getting in that last mile, that move. And I don't know what those numbers are. Is it 4.9%? Is that different than 5.1%? I don't think so. I'm guessing 3.9 is way different than 4.1.
The number you mentioned,
top line,
183,000 on jobless claims.
I don't, you know.
That is just stunning, Tom.
Yeah.
Stunning. That pushes back against the gloom in a major way.
This is important, and this is from one of our best people, Michael McDonough, I should say, of Bloomberg.
I thought you were going to say Michael Bloomberg. Also one of our best people, Tom.
Mike called me yesterday on Groundhog Day. Thanks, Mike. It was good to hear from you on Groundhog Day.
Really?
Adams didn't get bit. But what I would say here is McDonough's got a very important insight. The people he knows in tech are getting long severances. They're applying for unemployment. They're getting immediate contract work, maybe not at the salary and package.
Yep.
They're not playing foosball. I get that. But, you know, and they're getting there. And McDonough says, look, this is not Walmart. This is not, you know, layoffs at Walmart.
I think to McKee's point, and Mike's made this point a few times, Tom, that ultimately we've got to wait to see if this shows up in claims or whether people just transition from one firm, Lisa, and just walk into a job somewhere else.
And what you're seeing in other industries, in the restaurant industries, and the service industries more broadly, is that a lot of companies are not laying off workers because they are concerned about getting them back when times revive, just like their experience when they got burned during the pandemic. So a lot of companies would rather see margin compression now and keep their workforces bigger than they otherwise would.
Can I talk the unspeakable?
Please do.
Some guy's popping 722 at Google. He's going to go, oh, the world's changed. He's going to turn down 487 at some other firm.
I guess someone popping that kind of money at Google.
Yeah.
You talk about
No, there's a lot of there's a lot of people. No, there's a lot of people getting laid off at those.
I'll finish with this.
Income points.
There was a phrase, and I wish I remember who authored this phrase, but it's a fantastic one.
Of the night.
You can't fire what you couldn't hire, and I think that is really true of the pandemic and the years since. Ed and Zenner of Morgan Stanley, 7:30 Eastern Time, about 50 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's U.S. jobs report may show payrolls rose last month by the smallest amount in more than 2 years. Estimates say the economy added 189,000 jobs in January. Still, wages are expected to keep rising, and the jobless rate is near a 5-decade low. All that's likely to stiffen the Fed's resolve to keep rates elevated for some time. The jobs report comes out at 8:30 a.m. New York time. The incoming president of the Czech Republic says there should be no limits on military aid to Ukraine, except when it comes to nuclear weapons. Petr Pavel spoke to Bloomberg TV.
Ukraine can defeat Russia on Ukrainian soil. It means to push Russian forces out of Ukraine and restore territorial integrity and full sovereignty of Ukraine. I believe that with our support, this goal is achievable, and we should strive to achieve that goal because it's a matter of principle.
Pavel is a retired NATO general who takes office in March. Next week, for the first time in 3 years, the border between Hong Kong and mainland China will completely reopen. That's designed to revive the city's role as the business gateway into the country. Daily quotas and COVID testing requirements will be dropped. Hong Kong will also allow unvaccinated travelers to enter the city. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
We are the new NASDAQ. The way the NASDAQ performed in the 80s and 90s, that's where we went for innovation. Okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes.
Kathy Wood's the new NASDAQ.
Yeah.
That was the ARK Investment Management founder and CEO. TK's ready to go. TK's the new Dow.
Yeah, I think that
TK's the new Dow.
I got my Tang down here, but I need the surveillance
for a long time.
right now.
Well, I will say she also is saying the Fed should drop rates so that they can encourage innovation.
Oh, of course, yeah.
And the interesting thing is, I was speaking with a venture capital head, and he was basically saying he thinks higher rates will actually increase innovation because money will go to the founders that actually are able.
Because only the good ideas in history came around when we had
low interest
rates at 0%.
Obviously.
And QE, clearly. Nothing to do with the valuation of the stocks that might be in the new NASDAQ. No.
Nothing.
Not at all. TK, you ready to weigh in, or you want to avoid?
I really want to avoid talking
Move
about
on.
Kathy Wood. I just, I got a nice Friday karma going here, and, it's good.
You gonna do yoga?
Cool, nice.
Yeah, let's move on. Alec Webb, you're going to do a Tech Giants thing, or I'm sorry, John, I was stepping on you there.
No, don't worry about it. What are we talking about?
A woman stopped me in the street last night.
What'd she
said,
say?
do you and Pharaoh ever really talk when you're not on camera? And I
We're
said,
asked about that all the time.
Yeah.
Even when we're together, people come up and ask the same question.
This is so ridiculous.
And TK says, don't tell anyone. Don't tell anyone.
If you want, I can look.
Tech giants Apple, Amazon, Alphabet posting some disappointing results after the close, showing sales softening, consumer demand a little weaker, and expected online advertising growth not coming in the way some of you anticipated. Equity futures off the back of some of that, Tom, down. And looking at these individual names, Apple off by 2.7%, Alphabet off by 4.5%, Amazon off by 5%. I've got to do this again, haven't I? Give me a second. Take me 2 seconds. I'll pull it up on a Bloomberg. You've got to look at where we were yesterday at the close, just looking at some of these names. I could bring up Apple, up 3.7%. Amazon was up 7%. Alphabet was up 7% at the close yesterday, Tom. So you have to compare and contrast where we finished yesterday with where we are right now. And some of those names are still up.
Yeah,
over the
heaven
last 24
forbid.
hours.
Heaven forbid you put it in perspective. I thought Zero Hedge, frankly, did a good. They ended their tech analysis of Apple and using a lot of Mark Gurman's great work with the volatility you mentioned.
Sure.
And they went, it's back to ... where it was yesterday. Which I thought was great. We're going to get perspective on this away from the financials, and I take real issue with the coverage. I thought the foreign exchange delta was huge, for example, at Apple, and painted a more constructive picture. Dan Ives will be with John Farrow in the 9 o'clock hour on that. Right now, we do better with Alex Webb of Bloomberg Quick Take joining us here as well. Alex, with all the hype and the product stuff and all that, frame the level of crisis you see among the big four. I mean, we're going to go free cash flow in a moment, but what's the web crisis meter look like right now on big tech?
I mean, it seems like there's basically a return to the mean. We had sort of rewind a few months. We saw Facebook trading at, less than 10 times forward earnings. We had Apple in the high 20s, Google in the sort of high teens. They were all sort of tightening a little bit, coming towards each other. And some of these companies clearly over the past decade or so didn't really need to worry about how much money they were spending. They were growing,
Right.
Gangbuster growth. Now, a little bit more focus on that. Mark Zuckerberg almost said it explicitly. He said we didn't really need to worry. I mean, quite these many words, but he said we didn't need to worry about how much money we're spending. Now we do. That's the sort of difference as well we saw with the earnings yesterday compared to Meta a few days ago, that it was pretty explicit about needing to change the culture, needing to actually focus on how much money it's spending. It said its total expenses be $5 billion a year less.
Right.
We didn't see that quite sort of rhetoric come out of these other companies.
Alex, John emailed me at 2 a.m. this morning. He said, Tom, do a four-stock free cash flow study. Let's do it right now. I went out 1 year forward on the Bloomberg Intelligence modeling of the four great companies. Good morning, Scott Galloway, who I'm stealing this from. On the big four, they have a summed free cash flow of $250 billion. They add them all up, it's $255 billion, Apple leading the way. What's stunning is the next four stocks, Warren Buffett, Exxon, and two other tech companies, is 50-some billion. I mean, 57 billion. I mean, the drop-off here, the uniqueness, Alex, of these companies, I don't think is understood. $250 billion versus 57 billion, which frankly is mostly Exxon. They really stand alone, don't they?
And frankly, when we talk about Facebook, and there was a lot of conversation, as I just said, about the way they're changing the culture, sometimes easy to forget. They also announced another $40 billion of buybacks. So, they have the ability to drop huge amounts of capital on the problems they have, whether it be the stock, whether it be technology. The one thing that is a far greater challenge is, of course, M&A, right? Microsoft's trying some things. We don't know for sure whether they're going to be able to do this Activision Blizzard deal. Apple tends to steer away from those massive transformational acquisitions. They have a huge amount of capital. How you allocate it, now they're having to think a little bit more creatively about how to do so, given the headwinds they're facing.
There's been a lot of hate toward Elon Musk over at Twitter and what he's done with the firings and some of the disruption there. But how much under the hood in some of these earnings reports from the likes, even of Alphabet, is there a bit of a nod to what he did, saying perhaps we can strip back a lot of the people that we have and implement artificial intelligence around the edges to do it more efficiently? We heard the same kind of tone from Meta.
I mean, look, there was massive hiring. The numbers that are most telling is when you look at the evolution of revenue per employee. And if you look particularly at Amazon and Facebook, you saw actually that revenue per employee shrank, i.e. they were hiring people more quickly than they were able to grow revenue. So despite the pretty stellar numbers that some of them were able to post in relative terms during the lockdowns, actually they appear to overhire. Now, that is less the case at, say, Apple or Microsoft than it is at Amazon and Facebook. Now, Twitter is a company that, sometimes it's easy to forget. It isn't a big company in the grand scheme of things. Huge impact, huge, effect on democracy, amongst other things. But, I often think in UK terms, its revenue is less than BT, British Telecom's profit. So that also means it has far fewer employees. The impact of cuts at Twitter are far greater than the impact of cuts at these other companies. I mean, it's tough, obviously, for the people on the other end of that, but the cuts that are being made by these companies is quite small in comparison to what's happening at Twitter.
Alex, you said something that I want to pick up on, that they're not growing at the same pace where they can just keep hiring in this dramatic fashion. What does it say about where the valuations are if we're not in an era of free money anymore? I mean, yes, there's still behemoths and cash cows, but are their valuations justified if that growth, if cloud computing isn't accelerating to the same degree, if the potential perhaps looks a bit different?
Yeah, and that's why you have to differentiate a little bit between all these companies, because Facebook is trading still at a discount to the S&P 500, Google's about there or thereabouts, Apple at a slight premium. Amazon historically has traded at quite a large premium, but that is because the expectation always was that all they could, if they twist the spigot a little bit, they could actually move into a far more profitable space. What we saw during the lockdowns is they massively expanded capacity in warehousing, in headcount, all these other things, but all of a sudden it actually became a little bit harder just to reduce your spend and move towards profit. With the cloud slowing down, it is still growing. It is still faster than any of these other businesses. The pace of that growth is tempering. One interesting wrinkle in all of this is some of the chip companies, AMD, they reported recently, they make the chips for these servers. The numbers weren't actually all that disappointing. There's a suspicion that companies are actually doing more on-prem. They're actually building their own servers, not barreling as fast into the cloud as they were, because their processes they kind of want to keep to themselves. It'll be interesting to see if that story actually holds true, if that bears out over the years ahead, but there is a little bit of a wrinkle amidst all of that.
Interesting. Alex, thanks for that. As always, Alex Webb there of Bloomberg over in London. Equities are softer off the back of some of these stories. We're down 0.7% on the S&P, the Nasdaq down by a little bit more. We are about an hour and 35 minutes away from payrolls in the United States of America. We're looking for something in and around 200K, maybe close to 190,000, Tom. The estimates are in. That number might change a little bit going into the print. You want the whisper number? Mike McKee's going to bring us the whisper number later.
How do you feel about whispering on air?
Whisper it. I don't know. The president's kind of into it.
Yeah, I know you are.
But he uses it to make a point.
So is Tom.
You do one
Tom
over.
does that too.
You do one over the square root of whatever, except with payrolls, the square root is 150 million. Plus or minus. It's a ginormous number. And what that means is the standard error around the guesstimate of what, John, 189,000 seriously, is like,
well, I'm pleased you've called it
like,
a guesstimate.
It's a guesstimate.
It's really educated people.
I get all these emails.
Throwing darts.
Guess. Yeah, no, I get all these emails like the polling, guess it. It's a joke.
You don't provide any guesses in those polls? Wait until you get the UMitch phone call and you're asked about where you think inflation's going.
I'm still waiting. I'm waiting by the phone.
I want Michael from UMitch.
Maybe they're listening.
I want Michael.
Ellen Zentner has a tough job. She's got to actually guess this stuff.
I want Michael. Inflation's going to 5. Did they even ask you, what do you think? They just want a number?
They just want a number.
Do they give you a range?
So actually, that's a really good question.
Or can you just throw out like 20? 25?
And they hang up.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, oh, the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Markets should take notice. No one's pivoting anytime soon.
When you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over.
It's not just about the Fed, it's also about what's going on in the rest of the world.
All central banks are going to be in a similar position. Key issue, of course, is the extent to which price pressures are coming off.
It's when the labour market breaks that we really struggle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
90 minutes away from the payrolls report in the United States of America, live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance with Tom Keene, Lisa Abramowitz and Jonathan Farrow. Futures down about 0.7%. That's not the story of the year so far. Story of the year so far, a monster rally to start 2023. TK, going into payrolls, we're looking for 189,000.
Measured by the VIX, 23 to 18.44. But what's in the research and what I'm going to look for in the reading this weekend is, do we have a change in volatility where maybe we're getting clarity out of three central banks? I think it's important, John, to not just look at the Fed, where they're saying, okay, disinflation is in trend in some way, and does that lead to a new lower volatility regime? That's sort of the mathiness of where we are right now.
Well, clearly there's a challenge for these central banks. How do you respond to favorable data without easing financial conditions even further? And that's been a challenge for the central bankers so far this week. When Chairman Powell talks about the disinflationary trend beginning, and President Lagarde says the risks around the inflation story have become more balanced, clearly that is new information the market's going to pick up on.
Well, the question is, do they care? Do they care that the market is rising? Do they care that financial conditions are easing? It seems like he didn't care enough to really push back, which either means that they don't think that's that significant, or they think that it won't make a big, that won't make that big of a difference, or they were sort of unintending this to be the case and messed up.
They reaffirm data dependency, and even more than the ECB. Maybe the Bank of England's in that group as well. But I'm sorry, Jen, it's about the data this morning here in, what is it, an hour, 90 minutes. We're going to see that, and also on to Valentine's Day and that key CPI report.
Before we get there, Tuesday, February 7th, in Washington, the Economic Club of Washington with David Rubenstein, Fed Chair Jay Powell. That's the opportunity. If you really cared about how we responded to this, that's the opportunity. That's the stage right there to say something, Lisa.
What he could potentially say is that the market isn't factoring in the pain that they think is required along the way to get down to inflation, right? That perhaps the market is not paying attention to the deceleration in growth, right? So there's a push-pull here. He said both, that the disinflation is happening and that growth estimates were going up. He signaled that. That's really the green light for the market.
Quote of the week, Dom Constant, Mizuho. Even if it's a hard landing, it'll look like a soft landing first. Just by definition, it'll look soft before it's hard.
He's super restrictive. That's his
really
phrase.
interesting conversation earlier this week.
He's saying, look, we're there. we're in this disinflationary trend. He's not alone on that.
Equities right now down 6 or 0.7% on the S&P, just to give you a feel of this market cross-asset going into payrolls in about 90 minutes' time. Tom, yields come in almost a basis point at 10-year, 338.49.
Yeah, I would suggest you on equities, bonds, currencies, commodities. I've got a more accommodative Bloomberg Financial Conditions Index. I mentioned the VIX under 19 nicely. But, John, what I'm going to say is this screen is going to light up maybe on payrolls, much more on wage dynamics. Average hourly earnings is what I'm watching.
A ton of data today. Let's get some of that for you. Here's Lisa.
Well, I'm really focusing on the same thing that Tom is. 8:30 a.m. we get the U.S. January non-farm payrolls report. Is it north of 300? Is it south of 100,000? Really, the question is going to be whether we see the wage gains really decelerate to the degree that people are expecting. If not, does that potentially make the market rethink some of this shift in Fed speak and ECB speak? At 9:30 a.m. we get the view from this current U.S. administration. Labor Secretary Marty Walsh joining Bloomberg Television with one Jonathan Farrow. Curious to see the view on labor amid a wage increase that people are trying to fight, right? How does he talk about some of the wage disruptions, the labor disruptions that you're seeing, even overseas, and how that applies to the labor force in the United States? And at 10 a.m. we do get ISM services data. And to me, I'm actually watching this possibly more closely than anything else because there is the potential for a real acceleration of services. We saw an ongoing contraction in the manufacturing sector. John, it potentially could go in the other direction for services, which really speaks to this bifurcation in the economy. On one hand, contraction in specific sectors. On the other hand, incredible resilience that continues pushing inflation perhaps higher than the Fed would like to see it.
That's the right word, Lisa. Thank you. Resilience, particularly in the labour market over the last few months. A lot of people anticipating that weakness, Tom. It just hasn't come around in the labour market, in jobless claims,
No, it's
in
been a
payrolls.
complete failure, and a major shout out to Neil Dutta, who I believe joins us later. And I also know James Glassman was on fire yesterday with J.P. Morgan. He says, yeah, people are talking small business angst. He said the reality is they're looking for the next employee.
Neil Dutta, Renaissance Macro, 8:15 Eastern Time, so about an hour and 10 minutes from now. Right now, Priya Misra, Global Head of Race Strategy at TD Securities. Priya, you had 3 calls, and thanks for being with us. And those 3 calls went as follows. It was rates through 5%, yield curve inverted all year, and recession in the back half of the year. Are those 3 calls still the 3 calls?
We still have that call, yes. I think the Fed is telling, I think the reaction function of the Fed has actually changed a little bit. Their urgency to hike, their urgency to take rates more restrictive, I think that's a lot less. They are more convinced of a soft landing. We're actually not. The data is strong. The labor market data is always lagged. I think it's going to be more lagged right now. The service sector is slowing, but in our view is going to slow a lot more in the second half of the year. So, we're still looking for a recession. I think the Fed right now is saying we don't know. We don't know if this immaculate disinflation, which is what we're calling it, will continue. There has been some disinflation clearly. In our view, for inflation to get to 2%, you're going to need that pain in the labor market. And I think that's what the Fed is saying. We don't know. They're going to hike 25. We think they're going to literally live meeting by meeting. We're looking for another 25 in March, then another one in May. I would say there's risk of another one in June. If inflation doesn't continue to decline at the same pace, there's risk of them going up to 5.25 and then staying there all year because they really need that inflation to get back to 2%. They really, don't want to let inflation expectations get unanchored. And the economy is going to slow down. So, we're looking for that recession still. But I have to say the case of a soft landing is higher today, and I think the Fed is sort of banking on that.
Priya, on the vanilla 2-10 spread, the difference in yield between the 2-year and the 10-year, the 10-year is the benchmark. It's what the media watches. What is your 2-year study? What will be the dynamic of the important 2-year yield?
I think the 2-year is largely about that terminal rate and then what happens afterwards. It's all going to come down to inflation. I have clients saying, why would the Fed cut this year? Well, if inflation continues to decline, if inflation is at 2%, the Fed is likely to cut this year. Now, our view is no, inflation is going to get really sticky. I mean, it's easy to get that first couple of percentage point decline. For inflation to get to 2%, we need wages around 3%. So if inflation is going to be sticky, I think the Fed is really going to struggle to cut rates. So that 2-year has not only the end point of the hiking cycle, but all the cuts that are priced in. We're pricing in 200 basis points of cuts between the middle of this year and and essentially 2 years out. What happens to that? I think is going to be a function of inflation. Our view is the Fed is going to hold still. They're not going to cut rates until they see wages close to 3%, until they see PCE close to 2%.
The exhaustion in everybody's voice today after this week is notable. It's palpable. And you said that this is the most confused Fed and markets that possibly you have ever seen. Where do you get conviction in any trade at a moment like this?
It's hard. I think you have to keep, risk positions light. I think the Fed has stepped down clearly, so volatility will be a little bit lower. But where's that end point? What do they do after that? All that is up in the air. I think we're going to have to go back to models. And a lot of people have less faith, including the Fed, I think, have less faith in models. The Phillips curve, does it exist? Why has inflation declined? So I think we're actually looking more at our models. We're looking at how do you get service inflation down with wages staying high? How do you get wages to come down? Does the unemployment rate stay here? So we're actually going back to econ one-on-one, but I can see for the market that's been used to forward guidance from the Fed and the ECB, we're getting no forward guidance. So I think the market's going to be whippy. You have to have these strategic trades, perhaps, like being long duration, for example, but have to be nimble around it. I think interest rates in the near term can rise because you talked about ISM services. That goes above 50. The consumer is still strong. Consumption of services is still strong. Then interest rates look too low. So I think we're trading it more tactically in the near term and having an eye on that strategic recession, just the Fed cut rates. I think you sort of have to play it. You have to be nimble because the Fed is nimble.
Hey, Priya, wonderful to get your view as always. Priya Misra there of TD, still looking for rates above 5%, still looking for a recession in the back half of this year. And Tom, ultimately, the Priya Misra call of the year, which was the end of last year, curve inversion through the whole of 2023.
Yeah, the duration issue is really important. If you take that chart back, I'm going to say pre-Volcker, I would suggest what she's calling for, to be polite, would be unusual, if not once in a lifetime. I mean, the depth that. Can we talk a social aspect?
Please do.
I'm watching New York City real estate. I'm not going to go into it right now.
Oh, no,
it's
please
really
go into
ugly.
it.
It's really, it's really ugly. Commercial real estate. Nick Bloom at Stanford is one of our best. We've had him on the show a long time ago. He owns a high ground on work from home. He's the one who's really, really, really looking at the math. The average has come down, the number of days work from home, and stopped. And it stopped at 2.3 days is what we're doing right now, work from home.
Is that the new normal now, too?
You look at the chart, and yeah, it says new normal.
Do you think we could do 2 from home?
I think that we move the chart. I mean, there is a surveillance aspect to it. We're sort of like jaded and chart on this, aren't we? I mean, we're not thinking like most people.
Not at all.
Yeah.
Because we kind of have to be in the studio.
Well, yeah,
we
particularly, Wednesday sleeping
that work.
here.
That didn't work out.
The marshmallows in the fire we did Wednesday night, for team bonding.
Sure.
But Lisa jumped into Kumbaya, and I teared up. I mean, it was really... After the Fed meeting?
Singing at the bar?
Yeah, we slept here.
Did you record that?
No, I did not. No, I think Chart Banner has it on Zoom.
It's like a fake fire in the middle here.
Is
that our campfire?
That's our campfire. They sort of changed to an orange hue.
This is like Trump and the Saudis. It's the white orb.
Do you remember that orb? Tom, I still don't know what that orb was.
The orb comes up and we all go Kumbaya.
What was that orb that President Trump had with the Saudis?
Don't know. What was that? Don't know. That's horrid.
When things were going well, it turned white, and when things were going bad, it kind of turned just like deep red.
Really? Did it change colors? No. Oh, Anne-Marie's got one in her living room.
We're done. At 11. Next hour.
Yes, Qantas, yes, I hear you. We're done.
Anne-Marie joining us down in D.C. up next.
We're lucky.
On a spy balloon. A surveillance balloon over sensitive nuclear sites.
I think we have to.
In the western United States. The line of the morning from the Chinese government, I thought this was great. We're gathering and verifying the facts. We hope the relevant parties will handle the matter in a cool-headed way.
Who are the relevant parties?
As the surveillance balloon just drifts across the country. Cool heads will prevail here. Okay, that's next. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The U.S. labor market probably continued to moderate at the start of the year. Still, wage growth, historically low jobless rate, and high vacancies are expected to keep the Fed from lowering interest rates for some time. Today's jobs report is likely to show that payrolls rose by 189,000 in January. It's one of the most dismal outlooks ever produced by the Bank of England. The central bank says that workforce dropouts have become an economic deadweight, and they've left the UK facing its bleakest outlook in generations. The BOE doesn't see pre-pandemic levels of output returning until 2026. Shares of Apple are down after the company reported its worst holiday performance in 4 years. Supply chain issues and a softening economy hurt iPhone sales. Revenue fell 5.5% in the December quarter, Apple's biggest sales period of the year. Still, CEO Tim Cook sees signs of a rebound in China. And shares of Amazon are lower after the company announced consumer demand is slumping and sales in its cloud computing division will continue to slow through the year. Amazon Web Services revenue fell just short of estimates. CEO Andy Jassy says his #1 priority is to cut costs. And Ford is blaming poor execution and continued supply shortages for fourth quarter profit that missed estimates. The results show the company is struggling to balance the transition to electric cars from conventional vehicles. As a result, Ford will ramp up cost-saving efforts. Job cuts will be part of that too. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Will a slowing economy finally hit the U.S. job market?
The real test for the bear case seems to be jobless claims.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Have we returned to pre-pandemic labor force?
You could see jobs go down to, say, sub 100,000 in the next couple of months.
That'll get their attention on Wall Street. The January Jobs Report, today on Bloomberg Television and Radio.
I think Kevin McCarthy is probably more important than Powell as far as the Fed easing cycle goes, and that's because of the debt ceiling. If you look at the last two big fiscal tightenings from the US, 95, 2011, around the debt ceiling, this could cause a recession. So all the market is doing is it's just applying some probability to fiscal tightening later this year, and that's why you're seeing these rate cuts being priced.
Joyce Saravelos there, the global head of FX research over at Deutsche Bank. Who would have thought Tom McCarthy more important than Powell to markets, apparently, at least in the view of Deutsche Bank? That's just a deep sigh on the research of Deutsche Bank. Lovely.
No, I don't mean Deutsche Bank. I mean the meeting. What do we know about the meeting? Nothing.
Between McCarthy and
It's
Biden.
bizarre.
No. The story today, you know what the story today is? Can we talk about the story today? We're going to anyway. There is a spy balloon, a Chinese surveillance balloon, over sensitive nuclear sites in the western United States. It's injecting new strain into the relationship. The pictures are phenomenal, incredibly clear. And this at a time, just before, we've got this planned Beijing visit by Secretary of State Antony Blinken. What's amazing is the way that the Chinese government has responded to this. And I'll share the quote with you from the Foreign Ministry spokeswoman. Said Friday that Beijing was gathering and verifying the facts and hoped, quote, the relevant parties will handle the matter in a cool-headed way. It's kind of unreal, isn't it? So here's the issue politically, and politics is often always about the optics. We're told this is not the first time, but for many people, this is the first time they're seeing it. And because of the optics around that, this makes it really difficult for Blinken to go to Beijing. What's ridiculous about that is it's not new and it's happened before, and Blinken was still going to go to Beijing, which just tells you, Lisa, sometimes politics just comes down to one thing, optics.
Especially when we haven't heard Tony Blinken say he's not going to go, but he will cave once people start to really pressure him and say that this is crazy. It's also fascinating that China is saying, we hope cooler heads will prevail, even though, potentially they're, even though, potentially they're one of the parties. But, there is a dissonance right now between the administration politically and this, what's going on in Washington, D.C., and the business community and the rest of the economy that is highly dependent on China for a lot of the revenue.
It's a big issue, Tom.
Can we do a balloon surveillance correction?
Please, Dave.
Helene Cooper, New York Times, corrects me. Thank you. Helene, she's got the path. I implied earlier that it came across the Pacific. Like, it was a party balloon at the Waldorf Astoria in Shanghai and came directly across the Pacific, which is what an amateur like me would think. No, the New York Times reports, are you ready? China to the Aleutian Islands of Alaska, down through northwest Canada, over Maelstrom Air Force Base in Montana.
I'm so glad he corrected this.
But is this thing supposed to go over America? Amory Horton joins right now on this. And Amory, I'm glad I got the map straightened out. Is this one big accident? Can't we just say to China, did you do this on purpose?
Well, these are the questions at the administration. And by the way, I was aware of that flight path because the Canadians had come out and said that they did see this surveillance balloon and also that they're looking into, quote, another incident. So still we're waiting on more details of that potential second incident that the Canadians are tracking. But these are the questions the administration is asking the Chinese, clearly. And I think to John's point, the big question is whether or not Secretary Blinken goes on this trip. In mere hours, he is set to go on this trip. And what I really woke up thinking after, a number of phone calls and emails last night is this almost a trial balloon from Beijing to see how the U.S. reacts? No, honestly, to see how the U.S. reacts in this kind of instance and how, as John said, what the foreign minister says, will cool heads prevail because the U.S. does want to make sure that they do have some lines of communication open and they put a floor in this relationship? Or is this messy planning? Did Xi Jinping sign off on this just days before this very important trip? Remember, a Secretary of State has not visited Beijing since October 2018. Or is this messy planning on behalf of Beijing?
We could play around with this all day. I'll try and ask a serious question. Anne-Marie, does this pose a physical threat? Does it pose an intelligence threat in any way, shape, or form?
According to U.S. officials, the Defense Department, it doesn't. Not physical threat to any individuals, especially those over Montana where it was spotted, and as well as a harm in terms of intelligence. But the U.S. has deemed that it would be worse to shoot it down because of the debris that it could cause, and they do not want to harm any civilians.
Have we confirmed that there's optics on board? Seriously, Anne-Marie, have we confirmed that there's some form of legitimate imaging on board?
Well, the U.S. does believe this is a surveillance balloon, so it's not just a floating balloon. It obviously would have some sort of technology. But again, the Chinese are already doing this with low-level satellites. And there also are things called drones, which most people and most countries are using. So that is why this is so peculiar. Why send a surveillance balloon when you can do the same, and are probably already doing the same, with low-level drones?
Well, that's what I was going
to satellites.
Anne-Marie, that's what I was going to say. Don't countries all spy on each other? I mean, doesn't China spy on us all the time? We spy on China, and that's just how it goes.
Yeah, so the Chinese answer will be to this is that they have been complaining about U.S. spying, whether it is spy planes, whether it is spy ships, for over the past decade or so. So for individuals in the government, this is probably, you know, nothing that surprising, but obviously it is taking the public by storm, and the optics are pretty terrible right now, given the fact that Secretary Blinken is supposed to make this trip. They're supposed to have a warming of ties when it comes to at least the communication part, but then you're going to have a tremendous amount of pushback, and you're already seeing it from the likes of Speaker McCarthy, from Representative Gallagher on the Republican side about why even having these overtures with China if they continue to do things like this.
That's what I was going to ask. What's the basis of warmer ties other than economic ones?
Well, there's the climate talks. That's an economic/environmental track. There's also the fact that there really has been a softer communication between Beijing and Washington when it comes to the military communications and those angles. And Bloomberg reported about a month or two ago that since Nancy Pelosi, former Speaker of the House, made that trip to Taiwan, that those communications have really been much more muted than they have been in the past. So it's not just economic, it's also about military ties. And we had Admiral Kirby the other day talking about the fact that this is the most consequential bilateral relationship for the United States and for the world. And when you talk to allies of the U.S., they want to see at least the United States speaking with China. They do not want this to become fraught. They want to at least be able to say at least they're communicating to avoid potential escalation of this relationship and potentially conflict, which we saw this week, or was it last week, that memo from a Air Force general in the Pentagon talking about a potential conflict between Beijing and Washington as soon as 2025.
Anne-Marie, just quickly, you mentioned it, but remind me, when is Blinken set to leave?
He's set to be there by Monday, so
By
sometime
Monday.
over the weekend. Yeah, so that's what I say. This is a huge question they have to answer, and I imagine we'll get an answer today.
Amazing, amazing. Anne-Marie, thank you. Down in
Thank
Washington,
you,
D.C.
Emily, seriously. I mean,
What a story,
We're
Tom.
making jokes about it.
Hey,
but
what a story.
It's a story of our relationship with China. And I'm going to go back even before 1947, 1948. There's just a distrust. There is a trans-Pacific distrust, which America and, frankly, a good part of Asia has had to deal with for decades,
There
forever.
is a difference, Tom, between making a relationship better and stopping it from getting worse. And I think the effort of Blinken going over, and the administration said it themselves, TK was about putting a floor under the relationship.
Yeah.
That gets a little bit harder going into the weekend,
Well,
I guess.
it's just school of thought of diplomacy. You got to show up. And, there was a dearth of that. Somewhat. The critics of the Trump administration would say there was a dearth of that.
Will he show up?
Given the appearances, why send something so obvious, right? I mean, it's not subtle
Who
when you
says it
send
was
a
on
balloon.
purpose?
Well, but you think that they just accidentally did that for a party and then it
I
flew over
don't
to the
know.
U.S.?
Maybe it was supposed to go over Fairbanks, Alaska. I don't know. Maybe it was going to Helsinki. People they go over the North Pole. They don't fly like Shanghai. It went over the Aleutian Islands in northwest Canada. Where's it go now? Does it go to Miami?
You think it might be an accident?
I don't know. I don't know. Where's it go next?
Okay.
Stay tuned.
Payroll's 60 minutes away.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
Equities lower by 0.7% on the S&P. On the Nasdaq, year to date, absolutely flying. A bit softer, negative, lighter, lower this morning. We're down 1.2%. Lisa's going to run through some of the stock names you need to be looking at after the close yesterday. Tech facing a bit of trouble after facing a fantastic year so far. In the bond market, we look like this. 2s, 10s and 30s shaping up as follows. Your 2-year, 4.0998%. Came close to breaking 4% yesterday. Yields just drifting lower, plunging lower after the Federal Reserve on a 10-year to about 3.39 at the moment. Going into payrolls, looking for something like 190k. Looking at euro dollar looks a little something like this. Chairman Powell says the disinflationary process has started. President Lagarde says risks around the inflation story becoming more balanced. Euro dollar, Lisa, 109.34, positive there, 0.2%.
How much more oxygen is there in that? I just wonder about that. Have we all priced in the best news that potentially could be there?
Got a China reopening story in the mix as well. So I heard from Vasilios Giannakis yesterday of Citi, who thinks that any pullback on the euro by the dip on the China reopening story, and I guess we'll see. I find it so difficult to forecast European growth. I don't know what's going to happen with the war. I don't know how difficult the next winter is going to be. I think a lot of people are optimistic based on how this winter went, and ultimately, 3, how much growth, how much inflation do we ultimately import from China?
Yeah, and honestly, uncertainty is what's really been pervading all of the earnings that we've seen too. We went over Amazon, Apple, and Alphabet earlier, and just the offset to yesterday's gains. But I wanted to take a look at some of the other reported earnings and what we've seen, and sort of the bifurcated nature of a world where money isn't free. Nordstrom shares up 26% in pre-market trading. Basically, meme stock activist investor Ryan Cohen evidently has built a large stake in the department store operator. The reason why I find this interesting is because activist investing is much more present in some of the tape now than it used to be as people start to look at where valuations have opened up. Ford, this is really consolidation of market share. We saw GM come out with really good numbers. Stocks surged. Ford came out with a pretty big disappointment. Those shares down 6.6%. And this, to me, raises a question. How much do we continue to see a consolidation among a few winners, even as a growing number of others become the losers? Qualcomm fits into that as well. Those shares down by 3.2%. Disappointing on sales, showing some potential new businesses picking up. But you're seeing this bifurcation within the chip sector with respect to Taiwan Semiconductor Manufacturing Company and Samsung really gaining market share. But John, you see the rest of them kind of losing and trying to find out what the new business model is going to look like. And I just, again, how much is this endemic of an environment where money isn't free anymore?
I think it's true of a lot of tech firms right now trying to work out the next act.
Yeah.
Which is why on the earnings call, Tom, you hear that a lot of them talking about AI. All of a sudden, it's AI.
Yeah.
AI. As we look at deceleration in the cloud business.
They're hardwired to do that. I'm not really sure what to make of that. There's got to be some winning applications of AI, but you know, what's the other thing we're doing now? ChatGPT. GPT, yeah. You know, I mean,
that's where the job guesses came from this morning, Tom. ChatGPT.
Yeah, it's all the rage.
An hour away from the payrolls report for the month of January. The guesses look a little something like this: 190,000. Ellen Zentner has got a really fascinating call. 175 on payrolls, but Ellen Zentner looking for a pause, Tom. in March from this Federal Reserve?
It is a bit of an outlier call from Ms. Zentner of Morgan Stanley. She cut her teeth with amazing consumer analysis a number of years ago and has moved on to a broader, bigger picture of the market. She joins us this morning. Ellen, I'm going to go narrow on you right now. Ben Emmons, I think, writes it up beautifully at Newage Wealth this morning, in that ADP showed some wage disinflation, and Mr. Emmons moves from ADP over to average hourly earnings and says the shock this morning could be a legitimate wage disinflation. Is that what the market's trying to get out front of and celebrate?
Well, I think that's where the market's focus should be, because the headline number is going to be wrought with a lot of backward revisions, annual benchmark revisions.
Yeah.
You know, the wage growth really is more important here. So it would be nice to see some downside surprise or disinflation creep in wages. Obviously, the employment cost index is the metric that the Fed's going to follow most closely, but average hourly earnings is higher frequency, and we need something to focus on. But I think the point around ADP is important, because you also have LinkedIn, you have Indeed. These are companies that have been coming out with their own monthly wage reports, and it does show that, yes, wage growth is still high, but that the rates of growth have peaked.
Bring that over to another outlier, Liz Ann Saunders at Charles Schwab, talking this up big, which is housing, housing, housing. At Morgan Stanley, with all of your national contacts, are you seeing rents in home ownership inflation again come in?
Yeah. Now, we've been seeing the on-the-ground real data on rents have been declining since the fourth quarter of last year.
Give me a number there.
It's
from
the
7, 8, 9 to what?
Right. So, well, effective rents are different than what's in the CPI measure, but you're talking about 12% growth coming down to 7 or lower. In CPI, we want to see these extraordinary rates of rental growth that historically are closer to around 3-4% come down from where they're still around 6% or so, 6-5%. It's just too high, but the peak in that growth rate is in. We just need to see more of those declines. Now, in a lot of cases in this labor market data, we've had evidence on the ground from different sources for quite some time that wages would be coming down, that rental prices would be coming down, and it's taking quite some time for it to show up in the government data. Is it showing up now, and will it show up in a bigger way? I think so. But pinpointing the exact month that things start to really snowball is difficult.
It's super difficult. I think one thing we've all heard on this program, our audience have heard it as well, is that to get inflation back towards target, we need to feel some pain. Chairman Powell said that in Jackson Hole. There needs to be some damage. Yet we look at unemployment at 3.5% and claims at 183,000, and we all ask the question, where's the pain, where's the damage? What does that tell you? 183,000 jobless claims. How much signal is there for you?
So the signal there is that companies have been telling us that they're going to hoard labor. It took so long to even right-size payrolls. It was difficult to hire. So in this downturn, there's less, downturn in the labor market, there's less jobs to let go. It's more that hiring will slow. And so you're seeing that, and that jobless claims are not rising. Now, that makes it more difficult to estimate monthly change in payrolls, because we're not letting people go, and initial jobless claims are usually the most powerful indicator in your model when you're trying to forecast these monthly reports. But companies are not laying off broadly. We can set tech aside. It's a special case where they overhired during COVID. But broadly, we're not seeing layoffs. So it really comes down to just how slow will hiring be.
Does that make it harder for the Fed to hit its objective, or does it not make a difference?
I don't think it makes it more difficult. I think what we're seeing is that the reason why wage gains have peaked is because job switchers have declined, right? So churn in the labor market is shut down. The economic environment is too uncertain for people to keep switching jobs, and that's where the wage gains were pushed up the most. So I think it's more churn that's helping wage gains slow. But what I liked about the press conference this week was that, and I believe it was your Mike McKee that asked this, why have you been able to, why are we seeing disinflation? Why are we seeing that wage growth has peaked, that rental prices have peaked? Why are we seeing that, and yet the unemployment rate is still very low? I don't know if Larry Summers is wringing his hands over this, because he was saying that you're going to have to do significant damage to the labor market in order to get inflation to slow, and yet inflation is slowing and the unemployment rate is still low. I think that is an excellent outcome for the Fed.
Perhaps when he talks about the minutia of economics, it was a very successful press conference. If you're looking at a tightening of financial conditions, which ostensibly was a goal for the Federal Reserve, it was not a good press conference. Does it matter when it comes to the fundamental economy that financial conditions are loosening? Does it push the Fed further away from their goal?
So it's a really good question, and they are very focused on financial conditions. I think certainly if you're a policymaker and you look at financial conditions, you look at the unemployment rate that's still low, you feel that you can go further with the policy rate and markets can withstand that. But here's what I think they should be focused on. Financial conditions had an extraordinary run of tightening all the way through October of last year. That is what's impacting the economy now, where we're tracking just 0.2% GDP growth for this quarter. The easing that we've seen in financial conditions since October will be more of what supports growth in the back half of the year and will help the market grab onto that soft landing narrative that we've been pushing for so long now. So I think that's how we should look at it. I don't think they should be so disappointed that financial conditions have remained easy right now.
Which perhaps is the reason why we're not going to see big pushback. What's the difference between disinflation and getting back down to 2%?
So it's just the speed at which we get back down. Disinflation is that prices are still growing, but they're growing more slowly. And so in the Fed's own forecast, they believe it's going to take quite some time to get back down to 2%, that disinflation will prevail over the next couple of years and get us there. I think what we're seeing in market pricing is that based on the latest inflation data, the expectation is that maybe we're going to get down or see a faster pace of disinflation and get down to the Fed's goal faster than they think. And that's what the market is betting on.
The heritage of this at Morgan Stanley is Richard Berner with a lot of acuity and analysis. Ed Hyman at Evercore ISI's years at C.J. Lawrence, the same idea. Hyman is modeling sub 3% inflation. You just, Lisa's question I thought was dead on about the stochastic nature of disinflation coming down. Is this like any other disinflationary cycle in that we completely underestimate the rate of change to get down to 2.x% inflation?
Look, well, I wouldn't say in every cycle because inflation is typically a very slow-moving beast, and it's been pretty easy to forecast the disinflation that continues even after there's a slowdown or a downturn in the economy. I think this time we have to be humble because just as we missed it on the way up and it kept accelerating beyond expectations, you could have that happen in reverse on the way down. Something that Chair Powell talked about was the goods deflation, where goods prices are actually in decline. Well, if you think that that's just temporary, he used the word transitory again. God forbid we use that word again. But then you want to look at everything outside of that and say, okay, take away all the special factors. Are we just simply getting a reversal of COVID-related factors, or are we getting true disinflation more broadly? I think we are getting true disinflation more broadly, but that's not as pronounced as just the COVID factors that are coming off right now.
Just quickly, Chairman Powell speaks next week. Is there any kind of cleanup on aisle 4200 on the S&P right now? Any kind of cleanup act whatsoever that he needs to conduct?
Look, I don't think there's anything there. I think he can continue to harp on financial conditions being too easy. But right now, the market's pricing in a March rate hike. The Fed believes it's going to deliver a March rate hike. So where's the pushback?
You're looking for the pause and 175K at 8:30 Eastern. Alan, love it. Great to have you with us.
Thanks.
As always. Alan Zentner there of Morgan Stanley. Your payrolls report just around the corner. Next stop, 8:15 Eastern time, about 30 minutes from now, Neil Dutter of Renaissance Macro, the constructive view on an economy that's about to pick up for Neil and maybe a Fed that might be pulling back too prematurely. That's Neil's view coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's U.S. jobs report may show payrolls rose last month by the smallest amount in more than 2 years. Estimates say the economy added 188,000 jobs in January. Still, wages are expected to keep rising, and the jobless rate is near a 5-decade low. All that's likely to stiffen the Fed's resolve to keep rates elevated for some time. The jobs report out at 8:30 New York time. The U.S. will send Ukraine a new ground-launched bomb-tipped rocket. That's part of the latest military aid package. The weapon is made by Boeing and Sweden Saab. It won't be deployed in Ukraine anytime soon. It will take about 9 months for the first deliveries once the Air Force issues a contract. Next week, for the first time in 3 years, the border between Hong Kong and mainland China will completely reopen. That's designed to revive the city's role as the business gateway into the country. Daily quotas and COVID testing requirements will be dropped. Hong Kong will also allow unvaccinated travelers to enter the city. And shares of Nordstrom are soaring. Bloomberg has learned that the meme stock investor, Ryan Cohen, has built a sizable stake in the department store chain. He aims to replace at least one of the company's board members. Last month, Nordstrom slashed its annual profit guidance after sales decreased during the holiday shopping season. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
I actually think the March meeting is going to be really interesting for the ECB, and it was Chair Powell that made it that interesting. So when you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over.
It is over. Ibrahim Ragbari, Chief Currency Strategist at Citigroup. That's Ibrahim's view, not mine. Equity futures right now on the S&P down about 0.6%. Going into payrolls, 44 minutes away in New York City. We've got a bond market that looks like this, 109.34 on FX. That's euro dollar. Tom, in the bond market, 339. We're unchanged in the bond market, basically unchanged on euro dollar. Just a little bit of a stronger euro in the mix. Still waiting for German CPI. You mentioned that, Tom, earlier in the program. I think maybe next week. I think maybe next week you might get that release of German inflation. But ultimately, the takeaway, to Ibrahim's point, the Fed's lined up. The ECB's lined up. They're starting to see a trend that perhaps they can enjoy. They don't know if ultimately it materializes in a favorable fashion, but it's new. They're acknowledging it, but they're still trying to state their work's not done. They've got more work to do, but I just don't think many people are listening to that anymore, Tom.
They're going to listen to the jobs report here. I thought
Without a doubt.
What Ellen Zentner said about wage dynamic and what Ben Evans wrote about this morning for me is front and center. This is what surveillance is about, and it's been an exhausting 3 days for us, and our team has rallied to give you perspective. We just spoke with Ellen Zentner of Morgan Stanley. We will speak with Neil Dutta of Renaissance Capital. Somewhat on the same page. Dutta's the arch optimist. Zentner carefully sets a Fed below 5%. And then in the middle is Anna Wong, who had an historic call as chief U.S. economist for Bloomberg Economics, I'm going to say 12 months ago, saying 5% and above. Anna Wong joins us right now. Boy, the dialogue, Anna, the thought I heard in Washington was you falling off your chair in the middle of the press conference. How did you, with your framework of a Fed to 5%, react to the Powell presser and the market reaction to it?
So I think Powell made the mistake of behaving too much like an economist. I think the substance he delivered is very much hawkish. He talked about how, the super core inflation, services, ex-housing, has not shown any sign of disinflation, which is what we're seeing as well. It's steady at 4%. He also talked about there's more risk of doing too little than too much. Market didn't hear that, but what market heard is the tone, the lack of conviction in what he said. So I think my framework, our framework always has been, we estimate a reaction function of the Fed, right? I think Powell confirmed that their reaction function has not changed. It's really the input into that reaction function. So markets thinks that, the inflation is falling to low twos, and the Fed does not. They have the core PCE going to, 3.5 or above this year, and the market basically imply that core PCE would go down to 3, low 3s, or even below 3. So I think even maintaining that same reaction function that the Fed has, if unemployment rate should go to 5% at the end of this year, according to that reaction function, the Fed will cut by 50 basis points, which is what the market wants.
To me, what's critical here is in the jobs report that we see here in less than an hour, you're going to look at the wage dynamic. Can you adjust your terminal rates down if we get a quiescent wage dynamic this morning?
Definitely not. So we have seen in the past couple months that the data on average hourly earning is extremely noisy. And on top of that, they are revising the seasonal adjustment factors and all that in this January report. It's still up for a lot of revisions. And, we saw that the November alarming average hour earning rate was completely revised away in the December report. So in the March meeting, the Fed will still have 2 more CPI report, and by the May meeting, they will have another ECI report. They will put a lot of weight on those. But I think the significance of today's wage data would be how market react to it. If it's slower than 0.3%, then I think the market will extend the rally from the post-FOMC.
Anna, let's connect the markets and the economy. We're just speaking with Ellen Zentner of Morgan Stanley and asked her the connection, whether the loosening in financial conditions we've seen on the heels of the Powell presser will make any difference to the economy, works against them. And she said maybe not, because we've already seen enough tightening to really affect the change that they would like to see. Do you agree?
Yeah, I would generally agree with that. I think what Powell is seeing when he said that financial conditions has tightened significantly, or the same as December, is looking at the real yields. So if inflation is falling faster, then even though nominal 10-year yield treasury is going down, inflation is falling faster. So from the Fed's perspective, the real yield curve is, on the whole about the same. So that's what they're paying attention to, not to any kind of financial condition index by, Bloomberg or Goldman Sachs.
Well, but this is important, Anna, because we're all sitting here saying, it was a mistake. He was too nuanced. He had a shift in tone. He seems like risks are more balanced. And yet you and Ellen Zentner seem to be saying, no, he reflected the, economic thought as best as he can. He doesn't know how it's going to play out. And the markets, if they rally, that's going to be their problem, because ultimately it doesn't really feed back on the economy to such a degree. So if that's the case, does that mean they're not going to jawbone this market anymore unless the situation dramatically changes?
I think Powell is based, recall that at some point he said they care about the broad economic, financial conditions, not short-term financial conditions. So I think that if the Fed's view that inflation will stay high for a while is true, then ultimately the Fed will hold rates higher for longer, and financial conditions will tighten, the rally will go away. And so I think that's the kind of context that Powell is in. And if the markets turn out to be right, then the current rally would be justified, and it could help him achieve the soft landing that he wants. So I think he's just kind of cavalier about financial conditions because it will naturally tighten if the Fed's point of view turns out to be right.
Anna Wong of Bloomberg Economics. Anna, thank you, as always. Just the difference between what an economist hears and what an investor hears.
And this is what it's about, folks. Zentner, totally different than Wong. Wong, totally different from Dutta. And that's a conversation into the weekend. I love doing this.
There is a change.
I got goosebumps.
There's a change from Chairman Powell. There is a change.
Yes.
Just compare and contrast, say the bookends, Jackson Hole to where we are right now. Look at the arc.
Have more data.
The meetings in between, the Brookings
China's
interview.
opening.
It's become way more balanced about the risks around monetary policy decisions, way more balanced. Don't you think?
So here's the really key question then. He might be moving more toward the markets than the markets is toward him, right? Maybe underneath it, he and other economists believe in the Ellen Zentner view of things, where basically you see this disinflation moving perhaps a little more quickly than they previously expected.
He had the opportunity to validate the December dots. Didn't take it.
No.
So isn't there something in there? Isn't there some information to take from that? The fact there wasn't any real pushback?
Right. So I do wonder what the discussion was, and I am curious to read the minutes. And I know that, Tom, you may read the minutes, but the minutes are actually going to be fascinating this time
I'm
around.
serious. I may actually read the minutes for the first time in my life this time around when I get done with War and Peace. Mike out on Twitter with a brilliant Bramo chart. And this is something we haven't talked about in the 3 angry days we've had here. We've talked full faith and credit.
He's angry.
We've talked I'm angry. We talked dissent. I'm talking equity markets. I'm talking full faith and credit. We haven't talked the land of Bramo. And Mike, thank you for your chart out on Twitter. Thanks for watching and listening. Bramo spreads are talking, aren't they?
Actually, this to me caught my attention
The industrial,
as well.
the B double,
because you look
double
at
B,
investment grade, you also look at high yield, and basically this is the credit portion, the potential credit risk portion of the dynamic. Contracting on investment grade to the lowest going back to April of last year. You saw the biggest one-day decline in spreads on high yield bonds going back to November of 2020. So a massive bet on this belief in easier monetary policy and the potential boom that you would see subsequently in credit.
386 on spreads.
Yeah.
386.
And so to side, I guess it's related. Lagarde yesterday had to enjoy Italian spreads and actually nominal Italian yields.
What was that yesterday? 40 basis point move?
Explain why that's important to our American audience. Besides,
I think they're well aware of why that's important. Once again, it's an easing of financial conditions because they believe after the next meeting, 50 basis points, they might be done. They might be done, and maybe the Federal Reserve will be as well. What's crazy about this move in high yield is we started the year, and I'm looking forward to catching up with Rick Reeder at BlackRock around 9 a.m. Eastern time with Mohammed Al-Erin as well on this. We had this beautiful fixed income breakfast buffet, and everyone was ready to load up. It was looking great. Juicy yields, fantastic. 1 month later, where's it gone?
Well, that's a great question. And you hear people reassessing the bet, and yet, the fear of missing out is very present because people said recently the gains were in and then it gained more. So what do you do with that?
Well, I think to some people's view in fixed income right now is even if it backs up, there's just going to be another truckload of people ready to buy back in.
Unless inflation surprises to the upside, and that's why the payrolls report's going to be important.
Or growth breaks down.
Yeah.
And that's a big risk as well through the next couple of quarters. Payrolls.
That was your Bramo.
34 minutes away. Neil Dutta's going to balance things out in about 20 minutes.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Real rate projection both the market and the Fed has is actually pretty similar. The difference is just on inflation.
There's going to be an accelerated decline in inflation the second half of the year.
I think the jury is still out there that we can be comfortable and complacent that inflation is on the way down, all the way to targets.
The ECB has an inflation mandate, and I think is likely to reinforce that pretty clearly. They are still worried about inflation at this point in time.
What is clear, the ECB, having started late, still has some more room to go to the upside than the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Television and radio, Jobs Day 3, exhausting, fascinating days. And we sum it all up here, John, in this hour at 8:30. And I'm going to go right to it. For me, what matters is wage inflation reporting.
Well, I've got to say, Tom, it's certainly been more exhausting if you were short this market and not long, because it has been painful, brutal.
Or even cautious on this market. It has
so
been
difficult.
painful. Totally agree.
To sit this out, Bramo, almost impossible. And that's where the FOMO starts to kick in. This is where the data might put an end to it. Payroll's 29 minutes away. We're looking for 189K. Chairman Powell doesn't want to shape your forecast. It will come down to this, the income and information.
Yeah, although at what point do people just interpret the data as they wish, right? And then we've
That's
seen
always
this
the
again
way.
and again, right? That basically people derive the message that they want. And we saw that from the meeting that we heard from the Federal Reserve. Some people took that as absolutely the dovish pivot that everyone was looking for, even though he basically said, we plan to do more.
If you sprinkle in some hawkish language that I've heard before and it tastes the same, but then you give me something new, a splash of something different, that's what I'm going to pay attention to. And that's what I'm paying attention to, and that's what everyone's paying attention to. You can't sit there in a news conference and say, we think the disinflationary process has started, and expect me to ignore that and just pay attention to, we got more work to do, we got more work to do. No, that is a shift. That is a shift, and I'm going to go back to what England has said at Standard Chartered. It doesn't matter what I think about this. Steve England has said, we've moved away from unconditional hawkishness to conditional hawkishness. It will come down, Tom Keene, to the data.
Conditional data dependency is maybe the phrase I would steal from Dr. Englander as well. What I also see on this is earnings, and I get the hand-wringing, Lisa, over tech and all that, but as I stated earlier, the modeled FA screen on the terminal right now for the big four, good morning, Scott Galloway, is $255 billion of free cash flow generated by four big companies. I find the stock market angst just ridiculous.
Well, cash flow is unassailable. They have incredible cash producing skills. They dominate industries. They dominate the economy. However, what have we priced in terms of future growth based on zero rates that possibly isn't possible in an era of money that costs something and at a time where some of these technologies are normalizing? And I think that's where really the question becomes.
In defense here, John, of the gloom, and Ellen Zentner alluded to this just for her GDP call, I believe, for this quarter is pretty tepid, to say the least. With the disinflation, which is price up, yield down, with the disinflation that's NASDAQ 100 to the moon, is the idea nominal GDP comes in because the growth isn't there and the inflation component comes down as well.
Do you want the perfect quote? Here's the perfect quote. A window of opportunity when long-term interest rates typically fall prior to the magnitude of the slowdown being reflected in earnings estimates and the economy. This is the classic late cycle period between the Fed's last hike and the recession. Do you want to know who that quote belongs to and when it's from? Mike Wilson, November. That reads almost exactly precisely a description of where we are.
Yeah.
Right now. Like right now. And I remember at the time when Mike put that out, and of course you're all aware he's bearish right now in this equity market. When Mike put it out at the time, was leaning into the bear market rally of the moment. The question we were all asking is how big is the window? How big is the window? And there was a feeling maybe it went into year end. Maybe you were a little bit too early if you thought it closed then because it's still open right now. And I think that work, and I hope Mike doesn't mind me doing this, the work from November, I think is kind of appropriate to the moment we're in right now, so I'll share it again. There is a window of opportunity when long-term interest rates typically fall prior to the magnitude of the slowdown being reflected in earnings estimates and the economy. This is the classic late cycle period between the Fed's last hike and the recession. So even if you believe there is a hard landing, there is a decision to make. Do you want to participate in the rally, and how big do you think the window is?
Well, we're going to have to see on it. I mean, it's just, to me, everyone over the weekend off of what we're going to see, John, in 25 minutes is going to recalibrate and readjust. John, I'm looking at futures negative 21. And, John, I got to go to the Bloomberg Financial Conditions Index, which has been resilient and accommodative.
Oh, today. Chairman Powell says it's unchanged, Tom. Financial conditions haven't changed much. Futures are negative 0.5%. Yields are unchanged, TK. Let's call it 340 on a 10-year. Euro dollar positive.
Sort of stasis.
0.2%. 109.35. We're about 25 minutes away from payrolls. The number, Tom, the headline number, our median estimate, 189,000.
A perfect equity market guest to get us into the economics of Michael McKee. Neil Dutta will be joining us as well. Nadia Lovell joins us right now, senior U.S. equity strategist at UBS, steeled in the math and physics, the esteemed program out of Smith College, where it's 42 below zero this morning, I would suggest. Nadia, I want to go to the physics of this stock market. And you know that usually time in physics is squared. We have seen a massive squared time function across January and into February of a buoyant stock market. How does that end?
Yeah, we don't think it's going to end well. Of course, the rally so far has surprised us. I mean, coming into the year, we sort of had expected the economy to slow and to see more earnings cuts and the Fed to continue to hike. And the economy is slowing, and we are seeing those earnings cuts. They just not happen as fast as we would like to see them. But the market doesn't seem to care and ignoring that. Clearly the market is pricing in a soft landing, as well as optimism around potential cuts in the back half of the year. And so what that is saying to us is that the market expects inflation to come down quickly to the target and a recession to be avoided. We just don't think that both is going to happen. It's very difficult to see that. And even if it does happen, when you think about inflation coming down quickly, what does that mean for corporate top-line revenues? We think that revenues are going to decelerate faster than costs, and that's going to pressure margins. So either situation, we think that equities will be stuck between a rock and a hard place, but acknowledge that the returns that we had been looking for in the back half of the year has been pulled forward to this first half of the year, and we think that there is going to be some give back. So we think that window is closing.
Well, and that's where I was going to go to build on what Sean was talking about. How much further does that window have to go? Do you play in that window, or do you just sit on your hands and wait for something to happen that looks more akin to your projections?
We think that there's going to be probably some pullback in the market in coming weeks. Of course, a lot will depend on the 8:30 data, and we'll be watching average our wages very closely, as well as I think also the ISM services data that will come out later this morning. So that's going to be important. But when you look at it from a valuation standpoint, Lisa, we now have a market that's traded above 18 times forward PE. Even if you can squint your eyes and close your eyes and get to 20 times forward PE, which is a lot, that's 4,400 on the S&P. So from that standpoint, there is not a lot of upside to the market, even in that scenario. And we think that there's going to be risks to the downside.
We just saw tech earnings from the giants. We saw varied performance, still producing a lot of cash. However, perhaps the astronomical growth is waning just a bit. How do you assess what's priced in terms of interest rates versus profits?
A lot is priced in, and you can see that from the valuation standpoint and the premium that tech is trading at. And you would think that the environment is quite rosy for tech. And as you've noted, the earnings results have been quite missed, and the forward guidance actually has been below expectations. I mean, you're also even seeing profit-less tech rally in this market. I mean, we do acknowledge that companies are becoming more efficient, and we are more focused on those companies that are focused on improving those efficiencies, also to removing some costs and controlling capex in order to protect margins and free cash flow in this environment. You want to focus on those companies that have more enterprise and recurring revenues.
Nadia, you came out of college and you drank the Kool-Aid of the Capital Guardian Trust Company of Los Angeles and American funds. You were weaned on knowing you got to be in the market. If I have a Nadia level view, which sector do I hide in this market?
Yeah, I agree. Like this, you have to be in the market in order to participate. I think there in energy, this pullback that we're seeing in energy, we're surprised not to see oil prices higher given how fast China is reopening. But we need to see some of the more import data from China, and those companies are producing a lot of free cash flows, raising their dividends and returning cash to shareholders. So we think that this pullback is an opportunity there. I think you want to have a more balanced view on this market in terms of exposure to some of the defensive areas and also the cyclical areas. And I think also you might want to look at some, protection strategies in terms of protection to the downside, but to be able to participate in the upside should this market continue to rally.
Nadia, thank you, as always. Nadia Lovelder of UBS Global Wealth Management. FOMO's an amazing thing, isn't it? The fear of missing out is so powerful.
Oh, yeah.
TK, you'll like this. I think the stock market is that classic Veblen good, where demand for it increases as the price goes higher. It's just one of those things that markets I find just really odd, because in everyday life, the way we behave about any good or service is that if we see it on sale, we'll want to buy it. And if the price goes up, we'll be shy about going there. And with markets, it's kind of the opposite. People have this fear of missing out on the way up, and on the way down, they're like, whoa, no, I'm out.
Stocks are all about the story, right? So the story when they go up is a lot better than the story when they go down, even if the profit perspective is perhaps a bit better.
Yeah, Veblen good, folks, to translate this is there's that scarf for those shoes you want at Louis Vuitton, and they go up in price and more people buy them.
Yep.
I'm interviewing Richard Clarida in the library of the Eccles building at the Fed. They have the mother of all economic libraries. I'm here, Clarida's here on radio. I'm describing this. I'm 3 feet to my left is the libraries, and they have a first edition of Torsten Veblen.
That's real money.
On the Veblen good. I said to Clarida, I said, when everybody's not looking, I just want to take three or four books.
This is the act they've missed. Never mind the classified documents. You want the first edition books.
You want,
no one's listening, Tom, so keep talking about stealing them from the Eccles building.
They got, the library at the Fed, folks, is spiritual. It's just fantastic.
Very
quality.
Cool. Neil Dutta's coming up about 4 minutes away. He's going to be around the table with us, going into payrolls and coming out of payrolls. We'll discuss them with Neil. Your payrolls report is about 18 minutes away. We're looking for 189K. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. As Jonathan just said, the clock is ticking before we get our latest look at the strength of the U.S. labor market. The January jobs report expected to show that the economy added 188,000 jobs. Now, that would be the smallest gain in just over 2 years. Still, it illustrates resilient labor demand that favors a soft landing for the economy. It's one of the most dismal outlooks ever produced by the Bank of England. The central bank says that workforce dropouts have become an economic dead weight, and they've left the UK facing its bleakest outlook in generations. The BOE doesn't see the pre-pandemic levels of output returning until 2026. Next week, for the first time in 3 years, the border between Hong Kong and mainland China will completely reopen. That's designed to revive the city's role as the business gateway into the country. Daily quotas and COVID testing requirements will be dropped. Hong Kong also will allow unvaccinated travelers to enter the city. The U.S. will send Ukraine a new ground-launched bomb-tipped rocket as part of the latest military aid package. The weapon is made by Boeing and Sweden's Saab. It won't be deployed in Ukraine anytime soon. It'll take about 9 months for the first deliveries once the Air Force issues a contract. And shares of Apple are lower after the company reported its worst holiday performance in 4 years. Supply chain issues and a softening economy hurt iPhone sales. Revenue fell 5.5% in the December quarter, Apple's biggest sales period of the year. Still, CEO Tim Cook sees signs of a rebound in China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We don't have a very consistent Fed at this moment. What we ended up having is a disconnect between Jay Powell and himself. Labor market is still very, very tight. And I think the jury is still out there that we can be comfortable and complacent that inflation is on the way down, all the way to target.
The fantastic Wei Li, the Global Chief Investment Strategist over at BlackRock. We are 14 minutes away from a jobs report in America. The median estimate in our survey, 189,000. And take a look at markets, just erasing some of the losses on the S&P 500. Still down by 0.4%, but well off the lows. In the bond market, yields not doing much, Tom, 338.67 on a 10-year. Euro dollar doing something, a little something, positive 0.2% at 109.35.
But it's a calm setup before before this jobs report.
The calm before the storm.
It's like a readjustment after the festivities of the last 2 days.
It's an important data point, Tom, and I think reflecting on the data we've had so far this week, ECI a bit softer.
Yeah.
That got the rally going.
Nice
Jobless
job.
claims, Tom. Jobless claims at 183,000, just amazing.
At a 4-week moving average, it's stunning. I would note the VIX, John, to 17.06 shows the bullish ferment that is out
Speaks
there.
to the rally we've had year to date.
Speaks to it. Michael McKee, ready to give you the data here. We'll touch on the report here in a number of minutes with him. But right now, we are thrilled to bring you Neil Dutta, head of U.S. Economic Research at Renaissance Macro. He has been more than optimistic. The market is confirming the Dutta optimism as well. Neil, within the jobs report, it seems like the wage dynamic is so important. What is the Renaissance Macro view of the use of average hourly earnings here in 12 minutes?
Well, certainly it's useful because of how frequent it is released. Now, obviously, I think like most economists, I think the ECI number that was released earlier in the week is more significant, and that does show some moderation in wage growth. I do think the broader issue, at least as far as I see it, is just how far we can push the kind of immaculate wage disinflation story with the labor markets as tight as they are. Sure, there's a little bit less churn in the labor market. There's not as many quits, so companies don't feel the need to bid people up as much as they had. But, ultimately, if economic growth is remaining healthy and in my view, potentially running above trend in the first half of the year, there's scope for the unemployment rate to drop a little bit. And obviously, if that happens, that can sort of further push up wage inflation.
So, Neil, do you think the Federal Reserve is on the brink of declaring victory too soon?
I think that's certainly a growing risk. If you didn't think that, before Wednesday, I think you should be thinking it's as more of a possibility after. I mean, I thought for me, the most interesting was just Powell's characterization of financial market conditions. He said that they've tightened considerably over the last year. I think, that's debatable. I mean, certainly real interest rates are higher than they were a year ago. But, if you look at things since, let's say September, there's been a significant easing of financial market conditions, whether you think about corporate credit spreads, whether you look at the broad dollar exchange rate. Obviously, equity markets have kind of revived here. And interest rates are down. I mean, one of the things I find most interesting within the financial markets is just interest rates are coming down. Look at what home building stocks are doing. If it was a recession, you'd expect rates to go down and home building stocks to tank. That's not what's happening. So what that's telling you is that, builders are going to be able to make things work here. That's why their stocks are going up. Sorry, go ahead, Lisa.
No, Neil, what you're dealing with, and you put this really well, is this powerful combination of both a Fed that potentially is close to done or even done raising rates and an economy that seems to be incredibly resilient with signs of even real strength in certain pockets. How long can you just ride that in the stock market?
Well, I think you can ride it for a little while. I mean, there's a lot of institutional inertia behind the Fed. I mean, they're not going to come around to my view after a couple of months of data. It's going to take some time. They're still very much wedded to the idea of the economy slowing down. No mention of the fact that auto sales just surged. I mean, think about what that's going to do to estimates of GDP. If you assume that auto sales are basically flat for the next 2 months, then motor vehicle consumption will add about, a percentage point and a half to GDP growth in the first quarter, and your own Bloomberg consensus sees growth coming in flat in Q1. So,
I want to get to you just because we're going to go to McKee here. I think John Farrell's going to go to Mike McKee here with a little jobs preview. Neil, this is really important. With your optimism, we get the inflation component of nominal GDP to come down along with some form of growthiness. Am I right that whatever inflation does, Neil Dutta thinks real growth will be tangible and is underestimated? Is that correct?
Yeah, I think the composition of growth will improve. in the first quarter. But that doesn't mean that the inflation issue is resolved. I mean, you can make a case, I think, for some upside risk to inflation. I mean, as an example, used car prices are probably picking up in the first quarter. You know, the dollar's come off. That may mean that the prices for imported consumer goods pick up. But, you know, again, I mean, the Fed sees these things too. And again, they're stepping back. They're signaling that closer to the end. So, you know, I think the issue for market participants is, look, I mean, growth is holding up. I mean, you don't have to buy into my idea that the economy is accelerating, but growth is holding up. You know, inflation's still elevated. Global growth is certainly picking up. And, you know, the Fed's not really willing to short circuit any of that. And so that kind of, I think, puts a, you know, a bit of momentum behind risk appetite here.
Neil, 8 minutes away from the number. Let's just wrap it up there. I know you're going to come back after the print to talk about it, but what are you looking for? We've got 189,000, the median estimate. Based on what you've seen so far this week, does it deliver some upside risk to the print, some downside risk? How are you thinking about that?
I think that there's some upside risk to the print. I mean, I do think there's a bit of residual seasonality in these numbers, but you know, what's interesting to me is what will happen with the work week. Obviously, that's been something the bears have latched down to, you know, over the last few months because obviously it's been going down. I do think that manufacturing activity is likely bottoming out, if not picking up somewhat in the first quarter. So I'd be keeping an eye on the manufacturing work week. You may be surprised to see it pick up.
Interesting. Neil, stay close. Mike McKee around the table with us. Mike, let's talk about it. 7 minutes away. What takes your fancy? What are you focused on?
Well, a couple things we need to keep it in mind. One is that this is January, so they are redoing the data on the household, on total population, and that means that the household numbers are not going to be comparable to December. So when we get the two numbers, don't try to compare January and December. We have this issue every year. But the thing that everybody's going to focus on is average hourly earnings, because it's inflation that the Fed is worried about at this point. And we've seen a decline in the rate of inflation. We saw unit labor costs go down in the fourth quarter. So if that trend continues, that's going to make the Fed feel a little bit better. You asked Neil what he's expecting, and he said there's some upside surprise. That's the Wall Street view. We have the whisper number out at 198. Yes, so significantly higher.
Do they do an average?
So you can see there, people are thinking that it could.
Help radio here. The white line moving up is the whisper number?
Yeah.
Crazy. Did they do whisper numbers like on average hourly earnings?
Not on average hourly earnings, but I think they may do it on unemployment rate. Although that changes so little that it would kind of not be a dramatic chart.
We've heard a number of economists come on our show and say really what's going to get the Fed's attention is if we get a sub 100,000 print for several consecutive months. How far away are we from that? Is that something that the Fed is looking at as sort of a line in the sand as well?
I don't think they're looking at it as a line in the sand, because at this point it's really about wages and wages pushing up incomes. We saw for many years growth in the 200,000s range every month and no inflation. So it doesn't really matter so much the size as whether people are paying up to get those workers. Now, how many workers do we need as a replacement level? 100,000 was sort of the view for a long time, but now David Wilcox, our head of U.S. economics, says 30,000 is all we need because the labor force has shrunk. So you got a long way to go before you'd run into any kind of issue.
And Zentner was touching on some of that, Tom, just the structure.
But I never heard that number, ever. And the Wilcox, by the way, folks, is a horse. I mean, this guy's the real deal.
Yeah. Mike McKee's the real deal. He's going to stick with us.
30,000.
The jobs number just around the corner, Lisa, 189,000, the median estimate.
Too. Keep an eye out for weather, because ADP said their number was bad because of bad weather.
Balloons over Montana.
Yeah, exactly. Look out for the weather. It's going to get real cold.
It is cold outside.
Thank you. Because we have this argument every single winter.
I know.
Where Tom just goes, it's not cold.
It's cold.
If it's not 1950, it doesn't count. Like every single winter.
Pretty much evergreen statement on a lot of things.
Every single winter. Your jobs report up next. Neil Dutter, Jeff Rosenberg, Mike McKee on deck.
seeds, typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Payroll seconds away, 20 seconds away. Equity futures going into it lower by 0.5% on the S&P 500 after a monster rally to start the year. In the bond market, your 2-year unchanged, a little north of 4% at around 4.1%. Your 10-year yields coming a basis point. Your 10-year right now 3.38. With the jobs report here in New York City, alongside us is Mike McKee. Hey, Mike.
Well, good morning, John. We're just waiting for the numbers to drop here. They're starting to come out. The unemployment rate falls to 3.4%. And I'm saying, oh my goodness, because look at the jobs created. 517,000 jobs. I don't think there was a weather effect there. And this kind of doesn't make ADP look great. So 517,000 jobs created. Private payrolls up 443,000. 19,000 manufacturing jobs. So those who were looking at the ISM reports and thinking that the manufacturing was shriveling and dying, not happening. As I mentioned, unemployment goes to 3.4% from 3.5%, and it looks like average hourly earnings come in as expected, 4.3, which drops it the rate to 4.4%. There's a base effect in there, and maybe some rounding on a 3-digit number because the expectation was for 4.3, but it does show continued progress. Average weekly hours, 34.7. That's a major jump for that category from 34.3. Labor force participation rate, 62.4%. It was 62.3%. So we've had some major gains here on the employment side, and I guess we'll have to wait just a minute to get to Neil Dutta because he's running around his room, opening champagne and jumping up and down. But this is a shockingly good report because we see a big gain in jobs without a big gain in earnings, and that's going to matter to the Fed.
Neil said there was upside risk. I'm not sure he meant that much. 517,000
anybody did.
In the jobs report. Unemployment 3.4%. Wages a little higher than anticipated year over year, in line month over month. But wow, what a move. And look at the move in the market. Equity futures down on the S&P by 1% on the S&P 500. The moves in the bond market, you can guess the moves in the bond market. Yields higher by 9 or 10 basis points right the way through the front of the curve. The 2-year up by 10 basis points to about 4.20 now. On a 10-year yield, we are higher by 7 or 8 basis points to 3.47. Elsewhere in the FX market, I think you can take a guess as well. Euro dollar negative, a break of 109. Tom, 108.71, down 1/3%. That is what we call, TK, a blowout jobs report.
Off the headline numbers, I take that statistic, 517,000. I add the 1-month revision. There's 2-month revisions as well, and it's a small number of 554,000. Mike, I'm going to go to you before Neil Dutta. And my basic idea is, I know you've never seen this before, but is the shock of these numbers because of pandemic dynamics and the end of the year moving around, or is the shock of these numbers, is it 98.285% of us?
Probably the latter, in the sense that we don't know exactly why we all got this wrong and why the number is so much bigger than anticipated. Because we're talking the establishment survey. We knew that the household survey would be disrupted in terms of employment because of the changes to the population control numbers, but the establishment survey isn't affected by that, and this is really a blowout. There's obviously probably some seasonal effects in there, probably some effects from the pandemic lingering in terms of the seasonal adjustments that BLS makes, but this just seems to suggest that American companies are not at this point feeling the need to cut back. Leisure and hospitality seems to be the big gainer, and we know that there have been a lot of openings there and that restaurants have been desperate to try to find people, so it looks like they are getting some people coming off the sidelines.
To try to understand the narrative behind this, Ellen Zentner was saying that perhaps wages are coming down more quickly than people had previously expected because there isn't as much churn in the labor market, the job switchers that push wages and wage gains higher. How much is that sort of masking the underlying strength that is going to be in wages for longer, even if we're not seeing it in the same kind of degree with headline numbers like this?
Well, it's hard to know how long it'll be in there because it'll depend on the composition of the labor force and who's getting the jobs. Obviously, people who are in tech moving from one job to another are probably making more money, and we've heard anecdotal reports that the people who are getting laid off are getting picked up quickly. Does it mean that restaurants are paying more? I'll have to take a look at the numbers in terms of average hourly earnings, but it suggests that we're getting to the point now where companies may not have to offer that kind of thing. The only point I would make is that Tom Brady is a job switcher, not a he didn't retire to switch jobs for a lot more money. So Lisa's point holds.
His wages skew the number, let's be clear.
I was going to say he moves GDP.
Mike McKee, thank you. That is a monster upside surprise. 517,000. The only big economist on Wall Street that came anywhere near was Citi and Andrew Hollenhorst, a little north of 300K. Neil Dutta looked for an upside surprise. Well, here it is. This is what Citi said earlier this week. Powell's hopefulness must now confront the data. The dovish market reaction to Chairman Powell's relatively neutral comments implicitly assumes inflation will continue to cool faster than the Fed expects, even absent a further tightening of financial conditions. Tom, here's a question for you. If Chairman Powell had this report in hand on Wednesday, in the news conference, would the press conference had been any different?
Would have been different. Yeah, I think so. I think that what I see here, John, that's so important, with immense respect to how Mike McKee owns this story, is you wonder, does the rest of the world begin to trust the data if so many people are getting this wrong?
Have we got the perfect guess for this?
This goes back to Jack Welch and his criticisms of Washington economic data, the late, great Jack Welch. And you just wonder, do you trust the data? Why don't you bring in the optimist?
Neil Dutta, the head of U.S. economic research at Renaissance Macro. Neil, are you seated or are you running around the room?
I just got back to my seat. Look, Tom, I trust a lot, just going to Tom's point, I think for your audience, it's not about trusting the data. It's about trusting the people interpreting the data, just in the same way political polls, right? I mean, the polls are off. No, the polls aren't really off. What's off is the people's interpretation of those polls. And that's what's going on here. I mean, keep an eye on part-time employment, part-time employed for economic reasons. Anyone who talks about that, it's a tell because it went up.
Neil, just because of time, I want to go on this. I think it's absolutely historic here. I'm gonna fold it, and there's other names as well, folks. Neil Dutta, along with the great Jim Glassman at J.P. Morgan, with his decades of study of the labor economy. He owned the study of teenage employment years ago. And John just mentions Neil Hollenhorst over at Citigroup, who came within the vicinity here. What are we getting wrong about the fabric of American labor when it's staring us in the face with large parts of America with 2 and 3.0% unemployment? Why are we getting this so wrong?
Well, I think it starts with, the underlying economic momentum in the country, which is picking up. I mean, it could well be that, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth. I mean, look, the underlying rate of employment is not 520,000. I mean, that is true, but it's probably higher than where the consensus believes. And, given what we know about the trajectory going forward, there's risk that employment will remain strong. I mean, if you're talking about 200,000, let's say it's half the rate. Let's say that's the real number, half the rate of what we got today. So it's 250,000. That's more than enough to continue pushing the unemployment rate down over time. And so, look, I mean, I've said this, the onus is on the economic bears.
Yeah.
Frankly, I don't think this is going to really change the Fed's calculus. I mean, guys, it's not like they're going to come out and say, "Oh, we got to go back to 50." All they can do at this point is just sort of extend out the 25s.
But Neil, how much are we looking at people who are getting multiple jobs because they're trying to deal with inflation? How are we looking at one person accounting for 3 of these jobs that have been created?
I mean, I have to look at the multiple job holders as a share of employment. That's in the household data. I haven't looked at that yet, but it doesn't look to be abnormal. And look, I mean, if you don't believe the BLS, what about consumers? Look at what consumers are telling you about the jobs market, okay? The labor differential from the Conference Board, also a January data point, that was out earlier this week. I believe it rose to a 3-month high. And it's at a very, very strong level, certainly, more or less where it was before the pandemic, if not a little higher. Again, consumers are telling you that things are okay in the labor market. And consumers, and this is drawing on research from the New York Fed, consumers have a habit of spotting changes in their own local economies before the data because they know the places that are, putting up help wanted signs. They know the places that are handing out pink slips, and they see it before the survey collectors of the BLS do. And so, consumers are telling you that the labor markets are fine and that unemployment is low. So if you don't want to take the BLS's word for it, maybe we can just take the American consumer's word for it.
Neil, get on the phone and tell some people I told you so. Neil Dutta there of Renaissance Macro. Fantastic to catch up with Neil. TK, he told us there's your upside surprise.
There's the upside surprise, and as you go into your hour, John, I go into radio, I really want to emphasize it with the equity. I thought the equity market pullback here would be bigger. The NASDAQ futures down 1.6%.
Sure.
Are, John, still sitting above the 2 standard deviation trend of the January explosion. I thought we'd pull back more given these stunning numbers. No, we have not.
Do you take comfort from the fact that wages didn't accelerate in the way that maybe you might have guessed if payrolls came in at 5.17 and unemployment dropped to 3.4%?
I'm not going to give my opinion on this. Nobody cares. But the answer is it is an inflation dynamic and a growth dynamic. And the Dutta optimist, the Glassman optimist, maybe Hollenhorst is going to join that group. I don't want to speak for him or Steve Whiting yet.
Sure.
But the bottom line is, do we have a growth misestimation that you mix into March and April?
I wonder how different that news conference would have been with Chairman Powell. Coming up in the next hour, looking forward to this, Mohammed Al-Aaron of Queen's College, Cambridge, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PG Fixed Income, and at 9:30 Eastern Time, we'll catch up with Secretary Marty Walsh, which I imagine he's going to have a little bit of a spring in his step, Tom, at the start of that conversation.
This is a social statement here, and Mike nailed it absolutely. The consensus has a view, and as Dutta said, they have not gotten this right for whatever reason. I mean, there's no other way to put it. Let's do this. We're going to keep driving. Do you have one insight quickly? Mike McKee, one insight here before Jeff Rosen.
Big change in service industry jobs. Service industry jobs leading the way with 378,000 jobs for the month. So we're seeing the jobs created or picked up in the area that people are looking for. And also the wage numbers were revised for December to up to an 0.4% and 4.6%. So the drop in the average hourly earnings is even greater than just what appears off the surface.
We'll save it for another conversation. And productivity and unit labor costs may be suggesting a better growth picture for the American economy. Jeffrey Rosenberg joins us right now. He's portfolio manager, systematic multi-strategy at BlackRock. Jeff Rosenberg, does this adjust a fixed income view of BlackRock?
Yeah, you have to understand this is a big pushback to the slowing, and it's a reminder of what Powell tried to say to the market, though the market wasn't listening, that their main concern is they're not yet seeing the impact of their tightening in the labor markets. And so this is a very clear message and a really kind of important warning that perhaps the interest rate sensitivity, put housing to the side, put the interest rate sensitivity of the economy to the Fed's tightening to date. Yes, there are long and variable lags, but we haven't really seen that degree of tightening. And when you take the financial conditions easing, the combined is perhaps what we're seeing here is the inability of the Fed to really get to its goal, which is to rein in the inflation pressures from a market. Powell said it again on Wednesday. It's still a labor market that is too hot.
Given that we are not seeing wages, Jeff, increase to the degree that some people might expect with such a headline blowout number, do you take comfort from that, or do you disregard that as a compositional effect of what jobs are getting created right now?
Yeah, the AHE number in terms of giving us a read on wage inflation is probably the most distorted because of the mix shift. Earlier this week, we got ECI, you've got ADP, and you've got probably the best measure, the Atlanta Fed wage tracker. At least those latter two are still pointing to an elevated level of wage inflation that I think is still very concerning to the Fed. And again, Powell was explicit when he said that earlier this week. The market wasn't listening. This report is a reminder that the hot, tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook.
How would you play this then, Jeff? If you really trust the headline number more than you trust the wage number, why would you buy 10-year treasuries where they are if you believe that this Fed could be that far behind the curve maybe later in the year before it's apparent?
Well, it's a good question, Lisa, and you asked about 10-year treasuries, and I think you have to be a bit cautious here on the degree to which we've seen the rally in back-end yields, and you don't have to buy those yields here. You can buy the shorter end of the market. The curve is at a historic level of inversion, and I think there's more vulnerability as a result of that. And from today's report and what we're seeing, not just from today, but for a long time in the data, the degree of tightness in the labor market may really challenge the ability of the Fed to deliver that pivot that the bond market's pricing in for the second half of the year.
Jeff, it's a little bit off your remit, but I'm going to go there because I know Alan Meltzer and Marvin Goodfriend beat it into you at Carnegie Mellon. And that is, I wanted you to link in here the shock of 517,000 and the 48 other numbers that indicate this job boom that some few have called for, and the Biden stimulus. It just seems, are we underestimating, Jeff, tranche one? Maybe this is for Glenn Hubbard's coming up as well. Are we underestimating, Jeff Rosenberg, tranche one, tranche two, and tranche three, which can be summed up, as Blanchard says, of the Biden stimulus? Is that what we're getting wrong?
Well, what we're getting wrong and where the confusion is at is a tremendous distortion in the economy from COVID, both the COVID impact and the COVID stimulus. And so we're seeing the backside of that. And really what you take out of today's report is really the strength in services. And this is the handoff from the goods economy to the services economy. But we're also seeing those distortions in our read of inflation. The deflation that we're seeing from the goods side is pushing down the headline and the core measures of inflation. It's making it look like we've made a lot better progress. Again, Powell talked about this on Wednesday when he pushed back against the market inflation forecast to highlight that we shouldn't expect that goods deflation to persist, and you're going to start to see some of that come out. So this confusion from COVID and the fiscal stimulus is part of that, is also what we're seeing in the makeup. The surprise numbers that Mike McKee highlighted is all from the services side of the economy, highlighting the transition and the strength that we continue to see there.
Jeff Rosenberg, thank you so much. Particularly thank you through this historic week. Mike McKee, he's looking at me like, before we get to Dr. Hubbard, you've got one nugget. What is it?
This is really interesting. We have a massive seasonal adjustment factor for the month of January this year. And on a non-seasonally adjusted basis, the economy lost 2,505,000 jobs. Last year, 2,420,000 in the month of January, but it was revised seasonally adjusted to 364. This year, 517. So an additional 200,000 jobs, basically, from seasonal adjustment numbers in this. And as we thought, this may be a hangover from the COVID pandemic years.
And I think it speaks to the unusual time of it. Lisa?
I just want to point out Alan Ruskin of Deutsche Bank just sending out that he thinks this data is far more befitting of the Fed view than the market. And that, to me, is really interesting.
Right.
Basically talking about how this is really confirming what they see.
My whipsaw on it, we got S&P futures down -50, but the 2-year yield shows you the whipsaw. Were we considering 3.99 down to 4.08? We back up essentially 18 basis points from that, now 14 basis points higher on the 2-year, 4.24%, showing the adjustments. It is a perfect guest at the perfect time. He was so much involved with the rebuilding of Columbia Business School. As we spoke to Abby Joseph Cohen of Columbia Business School the other day, he is Glenn Hubbard, director of Columbia's Chazen Institute for Global Business, and steeped in the underestimation that we have of the American economic experiment. Glenn Hubbard, I want you to speak of the microcosm, the initiative, the way we go out on a micro basis and find growth in America that pushes against traditional caution, traditional gloom. You've owned the high ground on that for decades. Are we underestimating the American business spirit?
Well, I think we are, Tom, and importantly, as was said before, we're underestimating how hard it is to forecast in the recovery from COVID as we change in the mix of consuming goods and services, how firms adjust, how industries adjust. I thought we would see an upside surprise, nothing like this, I confess, but it tells me the jobs market is much more robust than markets had thought. And certainly a worry for the Federal Reserve.
I look, Glenn, at the fiscal stimulus of this, and let's go to your public service for the nation, typically with those of the Republican persuasion. Olivier Blanchard, who you and I will agree knows the math, Olivier Blanchard calls this the Biden stimulus. Are we still witnessing stimulus effect that leads to these shock numbers?
I think we're witnessing two things. One is the hangover from excessive aggregate demand stimulus, so I agree with that. But we're also seeing a lot of adjustment as the economy comes out of the COVID pandemic, the goods boom, and now our recovery in services, which are very labor intensive. So I think when people forecast jobs, they have to do so at a more micro level, given both of those factors. And I think the job market's likely to remain hot, posing a real challenge for the Fed. Remember, the JOLTS data were pointing in the same direction.
I'm just thinking about what Alan Ruskin over at Deutsche Bank said in response to this jobs number, saying, more broadly, one has to think in terms of higher equilibrium rates in this cycle, given very unique labor market resilience, and therefore less expenditure sensitivity to rates. Glenn, how high do neutral rates have to go if this labor market is as strong as it seems?
Well, keep in mind, while the Fed has adjusted, one could hardly describe monetary policy as overly restrictive, given where inflation is. So I think there are two challenges for the Fed. One is figuring out how high, and I agree the Fed's not likely to revert to very large rate increases, so more gradual rate increases, but probably into the fives. But it may have to hold it for longer than market participants think. The Fed, of course, has been signaling that, but the market doesn't believe it.
Do you think that this kind of strong data makes the idea of a soft landing more likely or less likely because of how long the Fed will have to hold rates high?
I'm going to give you the classic economist answer, both. It could make it more likely in the sense that we obviously have a very robust underlying economy, giving the Fed some room to move. On the other hand, the possibility of a policy error here is quite significant. So I think this is a tough going moment for the Fed. It's not easy for the Fed. And markets, by occasionally loosening financial conditions, make it even more challenging for the Fed.
Glenn, I look at the path forward here. And I think one of the surprises underreported in the 3 tumultuous days we've had is productivity lifted. Unit labor costs came down. Are you an optimist that out of this horrific pandemic, all the shocks, all the once-in-a-lifetime events we've had, that we can find a new productivity?
Well, let me start longer terms. That's always safer for economists. I am an optimist about productivity growth future in the U.S., given technological advance and how it's penetrating through. I'm also optimistic that the recovery from COVID is leading to some reallocations that may raise productivity. That said, of course, we've seen a lot of productivity fluctuations, positive and negative, in recent years, and one swallow doesn't a spring make.
Glenn, we're talking a lot about trying to understand a very uncertain economic moment as the world recovers from a pandemic. There's a larger question that the Fed has to deal with as well, which is what is the implication of looser financial conditions and getting them further away from their goal of an ongoing disinflation? We've heard from a number of wonderful economists this morning saying it doesn't really matter at this point because of all the tightening from last year. Do you agree?
Well, again, I'm going to have to equivocate in standard econ way. Milton Friedman taught us years ago about long and variable lags of monetary policy. So there's reason to be cautious, as that view suggests. That said, there's a lot of momentum in the economy, and the way to tighten financial conditions is to tighten financial conditions. And so I think the Fed still has more work to do than the markets think.
Do you still think that this Federal Reserve should go above 5% and decidedly so?
I do so. I do think so. And thought so before this report.
And I just want you to talk to me about the return of the risk-free rate. You got the chalk in your hand like Professor Joseph Cohen up at Columbia Business School, and you got a lot of bright young people that have never known actual cost of money. What do you tell them about this new world that's the old world you and I and Abby used to know?
Well, I think it's a matter of reminding people of basic discounted cash flow math. It's whipsawing technology prices, stock prices, whipsawing prices of other goods producing sectors as well. And then also that higher returns for savers can be a good thing on the other side. So I think we're learning that risk-free rates in equilibrium aren't zero in an economy that's growing.
Very good. Glenn Hubbard, thank you so much. We're going to go to Ira Jury, Glenn Hubbard with Columbia, and of course, okay, fine. Thank you for that, Matt. We've got huge news streaming, and we're going to talk about this with our balloon expert, Lisa Abramowitz, joining us now from Balloon Central. These are stunning headlines, and they sort of allude, Lisa, to the mystery we're talking about. China says balloon is for civil use, climate research. Pick it up from there. Regretful.
So, from the Chinese foreign minister, they released a statement after we spoke all morning, and a lot of people were talking about that balloon over the skies in Montana that was a surveillance balloon. That was the accusation from the United States. China responding and saying it was regretful that the airship entered U.S. air due to a force majeure, saying that it was for civil use, as you said, in climate research. Again, how does this dovetail into Tony Blinken's expected trip there? He was expected to arrive on Monday. They have yet to make a decision about whether he will go. Just to understand this swirling drama, it really highlights the tense moment of just not making this relationship worse, let alone making it better.
I think it's an opportunity, and if we know what they know and they know what we know, they know that we know, et cetera. Did you get all that? And the answer is this may be comedy or mistake or force majeure, which is, I'm going to say, is a legal phrase and unusual. Maybe it's an opportunity for not celebration, but conviviality and a point of dialogue to restart a relationship that many would say is fractured. Is it an opportunity at the end of the day?
What, the balloon?
The balloon. Is it an opportunity?
I don't think it's a balloon opportunity. I think that this was either way. Perhaps it was a trial balloon, as we heard from Anne-Marie, to sort of test what the U.S. response would be. Perhaps it was just a mistake. Perhaps it was actual surveillance. Either way, it just highlights the fraught nature that suddenly this is the top news, is a balloon over the skies of Montana, potentially from China, because they're already potentially surveilling different things. This is about just further incursion into U.S. territory.
Stephen Engel will have a lot of coverage led by with our Asia team, and Curran and all. Vivian Mann, of course, with her leadership out of Hong Kong, radio and television there on the China trip of the Secretary of State. We've got a little more time. You got to the way this works, folks. If we can get a wide shot here, McKee sits next to me, and he has triple top secret stuff. And the reason they put him next to me is Bramel's got Ted Williams' 2010 eyesight, and McKee knows I'm blind as a bat, so he's got state secrets here, and I can never see him. What do you see?
I don't have any top secret documents at home. Please tell the special prosecutor. I'll give you one more interesting thing here. The labor force went up by 886,000, and that is adjusting for the changes on a monthly basis by the BLS this month. So massive number of people's coming into the labor force, which tells you something about why jobless claims are so low.
Hold on a second. This is really important. Is this confirmation of what people were hoping, who are all called overly optimistic, that you would see basically all the people who were on the sidelines after the pandemic flood back to the labor market in the face of higher inflation, basically reducing unemployment further, but allowing wages to not rise that much? I mean, is this basically confirmation of that?
Could be. It's kind of hard to tell because at this point, it's not a month you would expect that to happen. I mean, historically, people get let go in January who were temporary workers, and the weather is lousy. And you would think that maybe in the summertime when kids get out of school and go to looking for part-time jobs. So to have that kind of number in January is usually the thing you would get if there was a rebound, like if nobody could work in December because it was too cold.
You're going to be around today? You're not exiting. You're not leaving right now, are you?
They're not going to let me.
It's just amazing. Michael McKee, thank you so much. World-class effort there. And
thank you.
Really, thanks to Lisa. Should we say thank you to our team? We never speak to them.
Our team is fantastic.
The guest quality today, the range of this debate is something we'll fold into next week. And yes, on to Valentine's Day and the inflation report. Futures at -51. I'm going to call it a resilient stock market after what we've seen. Thank you for joining us. Bloomberg Surveillance.
$517,000 live from New York City this morning. Good morning, good morning. A blowout jobs report. Equities lower by more than 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Live from New York, coming up, a monster month of payrolls gains, just as investors look for the chair to hit pause, and weak tech results colliding with a monster rally. We begin with the big issue. It's Jobs Day in America.
I mean, nothing beats the payroll reports.
Look at the labor market.
520,000.
We're still looking at an incredibly tight labor market.
The onus is on the economic bears.
In terms of actually showing some of these cracks, getting that last little bit of inflation wrung out is going to be the hardest. Part of it is wages, and we're going to keep a very, very close eye on that.
Last month was 223, which was a bit lower than the month before, which was a bit lower than the month before that.
But I also think we need to keep a close eye on the services data. There is altitude to lose before I think the Fed gets really worried about the state of the jobs market.
The risks in the US is that the labor market does stay a bit stronger.
We're seeing the Fed try and keep its optionality open.
All they can do at this point is just sort of extend out the 25s.
Joining us now to discuss, Mohammed Al-Aaron of Bloomberg Opinion and Queen's College, Cambridge, alongside BlackRock's Rick Reeder. Gents, to the both of you, thank you for being with us. Mohammed, I've just got to say, wow. You've had 31 minutes to go over this one. Your reaction?
It's a three-part reaction. One, wow, stunning, awesome, great for the economy. Two, there's a bit of a puzzle. And three, there's a hope. So the stunning bit is the 517,000 job creation. You know, the top estimate was 300,000. This is way out of the league, and this is really, really good news for the economy, as is an unemployment rate down We haven't seen this level for 4 decades. That's all great. The bit of the wage growth came in line at 0.3, but the hope, John, is significantly more people entered the labor force. You've heard me say over and over again, it's the supply side that can save us in terms of avoiding bad outcomes. And it's good to see the labor force expand, labor force participation going up, employment to population going up. That's all good news.
Rick Reeder, unemployment 3.4%, the lowest since May 1969. Your thoughts?
I mean, I think it's impressive. I mean, how many months are people talking about we're going to recession, deep recession? Listen, I mean, we're in pretty good shape here in terms of where employment is. And by the way, you think about the average hourly work week, what the work week ended up being. I mean, you talk about real income into the economy. I think it's impressive. We think, went through the data over the last couple of weeks. There's still a dearth of people for the leisure, healthcare, education, accommodations, hotel, restaurant. We still think you're over 800,000 jobs shy of where you need to be on a trend level. So you're filling those jobs. And by the way, it's good for the economy because these are generally lower wage jobs. You're improving net disposable income for the lower wage cohort. So it's a good thing. I mean, obviously, does this pressure the Fed a bit? It does. But gosh, I actually think they should cheer this on to a large extent because inflation's coming down while this is happening.
We'll get to the Fed piece of it in just a moment. Equity futures right now down by 1.2% on the S&P 500, and the bond market yields higher, as you might have guessed, up 12 basis points on a 2-year to 4.22, on a 10-year up 10 basis points to about 3.49. Mohammed, the PMIs, the ISM is still sub 50, and I wonder what you put more weight on, that or this labour market.
So, John, that's what makes it really, really difficult. You could have also said layoffs, okay, which are going to be reflected in the numbers, in the actual numbers that are measured down the road. It's really difficult. I tell you, I have not seen such an uncertain outlook for a very long time. The balance of risks is on both sides. So it is hard. And for the Fed, it is doubly hard, because the last thing it wants to be seen is destroying the labor market to pursue an inflation objective. So this is a very complicated period right now.
No sign of it being destroyed right now, at least not right now, and not in that jobs report. Mike McKee joins us now for more. Hey, Mike.
Well, John, it is a shocking number, as you guys have been talking about. 517,000 jobs were created in the month of January, way, way, way above what anybody expected. But even more interesting, perhaps, is the fact that the unemployment rate falls to 3.4%. You ask why jobless claims are not going up? That's probably why. The participation rate rises as well. And look at average hourly earnings. Despite all the good news, they fade a little bit. The December number moved up by 0.1% on a month-over-month basis. And so the drop to a 0.3 move brings us down to 4.4%. We are moving in the right direction, at least as far as the Fed thinks. Now, the jobs, where they are and where they aren't, this is something I wanted to point out. We had a big drop in the total number of jobs created in the household survey, and on a non-seasonally adjusted basis, we lose jobs. The seasonally adjusted, we end up with 517,000. But some experts on this, including Omar Sharif at Inflation Insights, saying that the numbers look pretty clean, that that kind of seasonal adjustment is not unfair. So that may not be part of the issue. Where the jobs are, service industry jobs. Rick was just talking about the need for so many people in the service industries. 397,000 jobs, 79,000 in healthcare and leisure and hospitality. They're still short, but they picked up 128,000. Here's an interesting one, though, construction. I mean, this is January. This is when there's snow and floods and stuff all across the nation, and we're getting 25,000 jobs. So let's take another quick look before I go here at the average hourly earnings, because I want to point out that what we're looking at is a number that is coming down towards what the Fed thinks is sustainable. 3 to 3.5%, they believe, is the kind of wage increases you can get without pushing inflation higher, and it's heading in that direction. Now, John, I got one thing I have to add here.
Sure.
This was a mistake I made in the last show, so we'll call it a surveillance correction.
Please do.
There's nothing wrong with the open here, but I had said 886,000 additional people in the labor force. That's the total number of people that had been put in by the revision. The actual number in the labor force fell by 5,000.
I've got skin in both shows, Mike.
Yeah.
Don't worry about it.
Well, you weren't there, so that's on me, not you.
Mike McKee, thank you, buddy. As always, Rick Reeder, the Fed chair, Jay Powell. If he had this labour market report with him on Wednesday, would that news conference have been much different?
So that's a good question. Listen, I mean, it's a pretty robust number. Do you have to put another hike, another 25 onto what the Fed does from here? Potentially. But, you know, I go back to if inflation, and by the way, you can predict. I mean, we still think when you look at where inflation is going to get to over by the mid-year, we think you're going to get headline PCE down to 2.9, core is going to get down close to 3. By the end of the year, you're going to keep decelerating. You look at used cars, you look at some of the commodity prices. So we think inflation is coming down. And again, I don't think that the Fed, if you have a dynamic where you're not getting accelerating inflation, some of those exogenous shocks, supply chains coming down. Listen, I think we're still getting close to the Fed pausing. Do we have to go another 25 after this report? Maybe. But I think the key is rate volatility relative to where we've been is coming down, which I think is a really big deal.
Mohammed, I'll come to you on a similar theme. Is the chairman of this Federal Reserve on the brink of pulling back maybe a little bit prematurely?
We'll see. You know, John, my view, and I put it in a Bloomberg Opinion article, is they should have done 50 and then stop. And why? Because this is a really good time to get the rate hikes out of the way. It seems that I'm less optimistic than Rick is about inflation. And that's because of what he said about services and what Mike said about services. Services are booming. So we're getting the goods disinflation, which is going to stop at some stage. You know, prices can't go down forever. That's going to stop. We have services inflation where the balance of risk is on the upside, and these are less sensitive to the interest rate tool. So when I look at that, I worry a little bit that we may be too optimistic about the path for future inflation, and therefore I would have corrected the understanding of the market of the comments of what was said at the press conference. I wouldn't have let the market run away as fast and as far as it did.
Well, Mohammed, let's pick up on that, because you used that word booming. This market, until this morning, has been booming year to date. The S&P 500 up around 9% year to date, the Nasdaq up by 17%. The chairman was asked about financial conditions. It was the penultimate question in the news conference, and I think a lot of people came out the other side scratching their heads. Let's go back over it. Take a listen to what the Fed chair had to say on Wednesday about financial conditions.
Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. There's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast.
Mohammed, I'm not going to try and persuade people to have a different forecast. Financial conditions haven't changed that much. How did you respond to that?
So I think what he was referring to is what Lael Brainerd referred to, which is a very narrow set of financial condition indicators. Mortgages, okay, things that very, very narrow set. And if defined by that very narrow set, then he is correct in what he said. However, that's not how monetary policy works. Monetary policy works through a much broader set of financial indicators. That's why the Bloomberg index, the Goldman Sachs index is much more holistic. And on those measures, we are as loose as we were last February. So, you know, it may be that they're looking at slim down. Now, slim down has become the practice at the Fed, just like inflation now is core services, excluding housing, right? Yep. So it seems that we are in slim down mode when looking at certain data, which is understandable, but it's correct for the inflation data. I don't think it's correct for the financial conditions data.
Well, this starts to introduce the market question. Rick, was that a green light for you to buy risk?
So first of all, by the way, I have to go back to what Mohammed said because I couldn't agree more with one thing. So the Fed should go 50 and get out of the way and let the system do what it's going to do. I just want to reemphasize one thing. The service sector jobs are lower income jobs. You're keeping net disposable income higher. That cohort, rent, energy, food, is what burdens at it. As long as income stays high, it took 20 years to get inflation to 2%. If we run a little higher, and by the way, I think we're going to set a little higher in inflation than we have certainly over the last 10 or 20 years. But if that's the case, and we're closing the income gap and removing money from capital to labor, there's a lot of good stuff going on. So anyway, I just wanted to hit it because I think it's so critical. Anyway, back to your question. Listen, I think rate volatility is coming down. I think the Fed, I wish they did the 50 like Mohammed said, but let's say they do 25, and another 25. We're not doing 475s. You know, we said this on the show last month. Quality income, you still can lock in yields now. I mean, in the equity market, our multiples okay. The earnings season was just okay. Tech wasn't. Gosh, if you can buy quality income and lock in, you know, if you take some spread product and you get a 6 in quality income with rate volatility coming down, that's a pretty attractive environment. So, you know, I think this is one of those environments. The economy is slowing. I don't mean to say the economy is reaccelerating. The economy is slowing, but at a pretty good level. I like buying income and holding it. And over the next couple of years, rates will come down. And I like locking in some of these yields today and again, you know, we're going to get some opportunity here. We certainly heard from the ECB. They've got a bit more to do. Although, like I said, I think we're getting close to where these central banks can, like Mohammed said, step back, watch the system recalibrate. I think that's a big deal.
Rick, you're not the only one on a fixed income call. You and I have gone back and forth on this. The fixed income breakfast buffet is not what it was at the start of the year. High yield spreads are now sub 390. Has the story, the risk reward around that story, Rick, not changed at all for you?
You know, it has a lot. Your point is very well taken. You know, some of these spread sectors today, you know, the spreads are not that interesting. And so now do you think about, gosh, maybe I'll reduce a little bit of these high quality spreads and, you know, high yield, I would argue we can get most of that yield, almost all that yield for some of the high quality asset classes, particularly in some of the securitized markets today. So that's not that interesting. One of the things that I think is Europe now, because of cross currency basis and otherwise, getting some yield in Europe in some of the investment grade products, actually European high yield is still pretty reasonable. And actually emerging markets, you know, where you have a more two-way dollar, you know, taking some emerging market, the yields, particularly in local rates, the yields are pretty attractive. But yes, you are right. These spreads in some of the areas we talked about a month ago, agency mortgages, investment grade, are not nearly as exciting. So taking, you know, changing your risk paradigm a little bit, but still keeping yield in, I think makes some sense.
Mohammed, you wrote about this morning. We've had this rip-roaring rally. You get this fear of missing out. The price changes, so the narrative does too, so more people start buying. We've just had a stellar run of gains year to date, and we're only a month and a week into this. You wrote this morning, when markets are this hot, should you jump in? Mohammed, should you jump in?
So I looked at the arguments on both sides and concluded very much consistent with what Rick just said. If you're going to jump in much more selectively. At the beginning of the year, it was incredibly attractive, particularly fixed income, incredibly attractive. But we've come a long way. And now, as Rick correctly said, it's about greater selectivity. There are still opportunities out there, but they're not as generalized as they were a few weeks ago.
Given how robust the economy is, how resilient the labour market is, I'm going to keep that in mind when I read you out this quote from Mislav Matejka over at JP Morgan. He said, Q1, in our view, will likely mark a turning point as the fundamental confirmation for the next leg higher might not come, and instead markets could encounter an air pocket of weaker earnings and activity as they move through Q2 and Q3. Rick, Q2, Q3 feels like a lifetime away. Now, I know you don't believe in the hard landing story. You're in the camp soft landing, have been for a while, but let's assume you are in the camp that it's a hard landing. And I call you up, Rick, and I say, look, I'm really worried about Q2, Q3. I think we're going to hit that air pocket. What do I do between now and then? Is there a window here for me to put money to work? What do you say back to those people?
So, I mean, well, first of all, I think January was one of the most extraordinary months I've seen in my career. The short covering rally in places that had been beaten down a month prior was pretty extraordinary. And by the way, I saw a stat that was the most incredible I've ever seen. The companies that missed outperformed on a price basis than the ones that actually beat earnings. This was a crazy, crazy month in terms of what performed versus what didn't. I think today, the stuff that hasn't performed, where you actually have quality income, persistence. I mean, look at healthcare, how much it underperformed. Parts of healthcare are not going to see the same sort of growth, but there are parts where you're actually generating really nice income. So would I take some of those income-producing assets, some of the, we call it the quality income today, that have lagged in this surge to buy the short covering stuff that's rallied? I would do that. But listen, I think margin, part of why I think equities are just okay, is the margin compression is real. I don't think you're going to see a cataclysmic earnings dynamic, but in an economy that's okay, I think top line revenue is sort of meanders around, but I think you get margin compression, and so part of why I'd rather buy income, both debt and equity. I'd rather buy stable income, much more so.
Mohammed, it is the ultimate pain trade for anyone who tried to short this market, to see it rip the way it has. And for some people who have missed out on these gains year to date, I want to go back to the phone call analogy. Mohammed, for the people that sat this out, who want you to get back in, have you ever experienced that in your career, Mohammed? I'm sure you have on several occasions over the decades. How do you respond to that when the market starts to move the way it is and more people start to get on board? The fear of missing out takes over. I know where we are this morning. Put that to one side. I want to talk about the year-to-date move. Mohammed, what do you say?
Oh, the inclination is for you to get sucked in. Look, there's nothing worse than underperforming a rising market, especially after you've had a tough year where the returns were negative. Your clients say, come on. I lost money last year. I had an opportunity to recoup some of it, and you weren't fully invested. So the people who are not fully invested, let alone the people who are short this market, it has been incredibly painful. And I suspect a lot of people have given up. It started with the short covering that Rick talked about, but it's gone beyond that. Look, it's really confusing. I remember 2 months ago, you reporting on the consensus on Wall Street. And do you remember we were going to have a tough first part of the year and a good second part of the year? That was the consensus. Now it's turned upside down. We're going to have a good first part of the year, but it's going to get tougher in the second part of the year. And it just shows you that when you look at the three main macro drivers, growth, inflation, and policy, you can tell two-handed story for every single one of them, which means that the permutations that come out of that are very large. And that's where we are, John. And this is a really uncertain market. That's why at the end of the day, it's about if you end up being forced to make a mistake. No one wants to make a mistake. Which mistake can you live with? And that's not just a personal risk assessment, it's also a business assessment.
Hey, Mohammed, stay close. Equity futures right now down by 1.3%. We're about 11 minutes away from the opening bout. Just a stellar month of gains for this market and for the jobs market too. Yields are higher by 14 or 15 basis points on a 2-year. 425. AMH down in DC joining us for a conversation. Anne-Marie, I imagine that State of the Union gets edited just a little bit on the labour market.
Oh, it certainly does, Jonathan. How can anyone say that we're even close to a recession when you have 517,000 individuals being employed in the month of January, and on top of that, an unemployment rate we have not seen since 1969. So expect the president to come out today, declare some victory on the economic front. On top of that, Jonathan, later today, he will be in Philadelphia alongside Vice President Kamala Harris. Rare that you see these two individuals going out together outside of Washington, D.C., a joint event to talk about the economy. But obviously, this all points to a potential joint ticket once again for 2024.
On the same day you hear from the president in the State of the Union, February 7th, Fed Chair Jay Powell speaks in Washington at the Economic Club of Washington. AMH down in DC, thank you. Mohammed, I want to come to you on that. Are you expecting anything different from the Fed chairman next week than what you heard this week on Wednesday?
Really tough question, John. Really tough. And February 7th is going to be fascinating. I suspect he'd rather send other people to correct the market misunderstanding, if there is one, than himself. But it's going to be a really tricky appearance.
I want to come to you on this, Rick, in the bond market with yields higher by 14 basis points on a 2-year, on a 10-year by 12 basis points. Are we seeing some incoming information that challenges the bullish story for bonds, or is this an opportunity to pick up an extra 15 basis points of yield this morning?
Listen, I think this year is going to be about adding to yield into your portfolio. And I think, you know, when you get opportunities, I think you're supposed to take advantage of. There's a couple of critical things. By the way, I don't think we're going to see a significant rate rally. I think people have gotten on board. Rates are coming down. The front end's pricing easing. I think that's aggressive. I think that the ability to carry and create this income makes for what will be a good year in fixed income. But John, I think there's one really critical thing here that you used to ask me all last year, how much cash do you have? How much cash do you have?
Yeah.
The reason why you run so much cash is because you can't hedge it. You can't use interest rates. You can't use equity volatility because volatility is too high. You can't use the dollar when it's a one-way. It doesn't move around. Now you have hedges. That's a really big deal. You can build income in your portfolio. You know, if the economy slows, you'll see interest rates come down now for the first time. If you have a dynamic that equity volatility allows you to do put spreads, allows you to do some things in single name versus index. First time in a while you can hedge, means you can run less cash, have some income, and then build some hedges in. That's a completely different paradigm around managing risk and building portfolios than we were 6 months ago. The only thing you do 6 months ago is just sit on a lot of cash and hope that dulls the volatility of your portfolio.
So, Rick, let's make some news. I mean, you brought it up, not me. What's your cash position now relative to a couple of months ago?
It's much lower. It's much lower. I mean, you know, we're building, you know, we continue to build this quality income in the portfolio like we talked about the last couple of months. I mean, I think these yields, you know, particularly, you don't have to go out to the 30-year, but you can build income without taking a lot of credit risk, a lot of liquidity risk, a lot of beta risk, and you can build a 5.5 to 6 pretty readily and hedge it now. That's really interesting. So yes, we've run down the cash a lot, but I don't feel like we're hanging out there risk-wise because of the quality assets. The point you made earlier, do you have to run a lot of high yield? Do you have to run a lot of loans? You have to run commercial real estate? Not really. You could build quality income and sleep at night.
Hey, Rick, can we get Mohammed on board to keep coming back every payrolls Friday?
I hope.
He skips every other month.
If you want me back, John, you have to pick up on Anne-Marie's comment. You know, we haven't seen this unemployment rate since 1969. For Jets fans, that's a really consequent statement because that's when we last won the Super Bowl. So there's hope for us, and there's hope for the Mets that won that year as well. So this is a very hopeful jobs report.
Better times, Mohammed. Fantastic to have you with us. A good friend of this program, a good friend of mine alongside Rick Reader. Tremendous, the both of you. Just absolutely brilliant. 6 or 7 minutes away from the opening bell. Coming up, big misses in big tech. Wedbush's Dan Ives joins us on the disappointing results from Apple, Amazon, and Alphabet Plus. Secretary Marty Walsh coming right up. Equities right here going into the opening bell about 25 minutes away and about 20 seconds. Equities down by 1.3% on the S&P. On the Nasdaq, we're down by 2 full percentage points. If we bring up the bond market, the moves we're seeing off the back of this payrolls report, absolutely phenomenal. Yields high by 13 or 14 basis points on a 2-year to about 424 on a 10-year, up 11 or 12 basis points to 351. Tremendous moves off the back of a blowout jobs report. That's the price action. Let's get you some morning calls. First up, Deutsche Bank downgrading Ford to sell from earnings, highlighting the limited visibility into the automaker's supply base. That stock is down by 8%. Next up, RBC Capital downgrading Boeing to sector perform, warning that supply challenges will likely cap any upside to deliveries. That stock is negative 1 full percentage point. And finally, HSBC downgrading Meta to reduce $110 price target, expecting competitive and macro headwinds to weigh on future revenue. That stock is negative by about 2.8%. Just to round things out for you quickly, The moves we've had off the back of this payrolls report, tremendous. The number, if you're just tuning in, I don't know where you've been, the number 517,000 off the back of that. Equities lower by 1.4% on the S&P. Yields higher by 13 basis points on a 2-year to about 4.24. Coming up, big misses in big tech. Wedbush's Dan Ives joins us on the disappointing results from Apple, Amazon and Alphabet, plus Labour Secretary Marty Walsh on a blowout jobs report just moments away.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Tuesday, President Joe Biden delivers the State of the Union address. Join David Weston and Bloomberg's top political reporters and analysts live from the Bloomberg headquarters in Washington, D.C. as President Biden lays out his plans to tackle the war in Ukraine, Congress's debt limit standoff, immigration, and more. And stay tuned after the speech as we break down the Republican response. Special coverage starts at 8:30 p.m. Eastern, simulcast on television and radio, only on Bloomberg, your global business authority.
Let's get to that opening band and finish up this week. What a move we've seen through the week. Big week of gains on course for that. Set to take a big bite out of it at the open. About 15 seconds away, we're down 2% on the NASDAQ 100. On the S&P 500, down about 1.2%. Taking a slice out of this market off the back of a monster upside surprise on payrolls. That's the opening bell. Switch at the board and get to the bond market. Yields higher on a 10-year by 12 basis points. Your yield, 351.17. The dollar stronger. Euro dollar, a break of 109, 108.50. We're negative 0.6%, and crude positive, just about, by 0.2%, $76 a barrel. We're about 15 seconds into this one, following a major upside surprise in a payrolls report. 500,000, to be precise, on a payrolls report. 517,000 jobs added for the American economy. Equities down by a little more than 1% on the S&P. On the NASDAQ, down by about 2%. One sector to watch at the open is big tech. Apple, Amazon, Alphabet reporting weaker than estimated results and derailing the NASDAQ's run at a bull market. Wedbush Wedbush, making the case for buying the dip in Apple, writing the following: Cupertino is a Rock of Gibraltar tech story in a stormy macro environment. We would be buyers of this unique tech stalwart on China demand tailwinds and the gross margin expansion story. Dan, I'm pleased to say, joins us right now. So, Dan, for most people, that was a downside surprise. Why wasn't it that for you?
Yeah, I mean, because ultimately this quarter was all about the China shortages from the lockdown. 8 to 10 million iPhones. So I viewed the miss as sort of, ultimately really saw through it. Because to me, it's all about what the guidance and comments are going forward. This is an accelerating China story into the next few quarters. That's what Cook talked about. And even though revenues is coming down, gross margins, it's a 10-year high. And I think that just shows the power here that they're going to ultimately see. It's demand that continues to be firm. Supply was really the issue in the December quarter.
Dan, I just want to work through the price action briefly, about 90 seconds into the session. When you look at these numbers, bear in mind these names had a massive move high yesterday. Apple's down about 0.8, Alphabet's down 4%, Amazon's down by 5.8%. Dan, would you define Q1 then as a clean quarter to judge Apple by? Can we put you down on that one? This one's going to be a clean quarter and we can judge this stock. And if China comes through soft, there's something worse going on here.
Yeah, I mean, look, market, because I think 3 months from now, if that story ultimately takes hold, this is, a stock that's going on its way to $200. I mean, that's our view on the sum of the parts, because it also, you go into this earnings season, Armageddon expectations across tech, not falling off a cliff, modest softness. That's the narrative that really came across. And I think everyone was sort of underweight. I think it's as underweight as I've seen tech since 2009. That's what we're buyers here. I view it as a green light.
Well, that's a positioning story. Let's talk about the fundamentals. Deceleration in AWS, deceleration in the cloud business, elsewhere over at Microsoft. Dan, surely when you go from acceleration to deceleration, that's a shift. And these companies might have to be valued differently. How are you changing?
Yeah, and look, and I think ultimately the valuations were really reflecting massive decels. Instead, you've seen modest decels. And I think going into the next 12 to 18 months, then you start to see an acceleration back into what I view as a more normalized environment. You've seen the cost cutting. You got the Band-Aid ripped off. Ultimately, numbers are now hittable to beatable. And I think now it's set up where, we thought going into this year, tech stocks would be up 20%. You talked about it.
You got it in a month.
I ultimately believe it. No, but look, I believe now we sit here end of the year, tech stocks are up 30%.
30%. There is a danger here, Dan, that all of this was just short covering. You mentioned the positioning story and that we're redefining the narrative based on the price action over the last month or so. As I say, deceleration in the cloud business elsewhere. What is in the fundamentals that you see that makes you think that we get a re-acceleration in those themes when the companies are telling me completely the opposite?
Well, look, I view it, we're in the early stages of a fourth industrial revolution. From AI, that's why Microsoft paid $10 billion for ChatGPT. You look at what we're seeing in the cloud, only less than half the workloads are on the cloud. And I think we're now going into the next phase of technology trend. And even though we're seeing a slowdown in the macro, I think ultimately the cost cutting, that leads to the next cycle. And that's sort of our view for high quality tech. Profitless tech, some of that, they'll fall by the wayside. But also I think there's going to be a lot of M&A, a lot of activism. And right now, New York City cab drivers bearish on tech stocks.
Well, Dan Ives, I don't think that's the case anymore because we've had a massive run year to date. Dan Ives of Wedbush, sticking with the bullish call. It's working so far this year. Let's see if this changes. Do we actually get that re-acceleration Dan's looking for? Because the companies aren't looking for that. The equity market down about 1% on the S&P 500. We are about 4 minutes and 40 seconds into this session. On the NASDAQ, we're down about 1.8%. Just a fantastic jobs report. To see the jobs number come in at 517,000 and unemployment drop to 3.4%. That is truly, absolutely phenomenal. On Bloomberg TV and radio, I'm pleased to say that US Labour Secretary Marty Walsh joins us now from Washington. Now, Marty, did you have to edit your notes once you saw that jobs number in the last 24 hours?
Well, I looked at my economist and I said, you were way off today. It was, and I was on a call with some folks from the White House earlier, and they said, what do you think about the jobs report? I said, it was a good, steady jobs report. And Jared Bernstein made a joke. He said, you never change your tone. It was a great report. I mean, when you look at areas that I think are really important, business grew healthcare grew, education grew, and we saw strong, steady growth in construction. I mean, so those are areas that obviously you would know better than I would as far as signs for the economy and concerns about the economy. But right now, certainly I'll take this jobs report for any day of the week.
Well, Secretary Walsh, I've said it to you now 2 months running. I mean, you've been right. I've tried to push back, but ultimately we're seeing this jobs growth without that inflationary impulse, without wages picking up. We're seeing participation start to climb. Secretary Walsh, what are the dynamics underpinning that, do you think? Why do you think that can continue?
I mean, I think we're still going to be assessing that and evaluating that for years to come. I think what's happening at this moment in time is something that economists and folks like you and me and all of us will be talking about down the road. I don't think there's really an answer other than, the president did lay out an agenda in 2020 to get people back to work. And then in 2021, he laid out an agenda to tackle inflation. Obviously, the Fed is doing their thing as well. And I think we're living in a very different time right now, economic times. And, most economists or people who are business people won't really might not agree with what I'm about to say, but I just think that these are times we've never really experienced in this country, and we just literally have to take this month to month to see, as long as we can move forward and avoid a recession and avoid a downturn in the economy and try and create as many opportunities both for employers and employees in this country.
Well, the data is speaking to that right now, and the president has some fresh numbers to put into that State of the Union address next week. Secretary Walsh, I know you've got to run, so I want to work through a couple of issues with you. Here's one. You usually give us an update on what's happening on the West Coast with the dock workers contract. Where are we now? Have they asked for your involvement at all?
No, I mean, I've been in steady contact. This week I talked to all sides. They were able to work through some of the more tricky issues out there. They have not asked per se for me to come out and talk to them. I did go out January 2nd to sit down and talk to the companies and some of the union guys out there, union people out there. They're moving along. Certainly, as I said to you a long time ago, I wish this negotiation was done, but there's a lot of issues out there that they want to go through. But so far, hopefully we don't have anything that will hold this contract up, but certainly it's something I'd like to get done sooner rather than later.
You've been pretty calm about it, and I often ask you, when does the red light start to flash? Are we getting closer to that point for you?
No, it'll flash to me if there's an issue that I think is going to be one of those make or break issues. Like in the railroads, when we talked about, the negotiations weren't really going on as they're moving forward. When sick time came up, paid sick time came up, I kind of knew that was one of those red flashing problems. I haven't seen that yet in the ports negotiations, and I think that, the way they work is a lot of the unions work and negotiate with individual ports, but there is a master contract. I don't know if that's the technical name for it, but right now I'm not concerned about that yet. I mean, listen, it could change on a dime, obviously, but right now I feel good.
Secretary Walsh, usually Tom Keene and I like to talk about football, real football, the stuff that happens outside of the United States. I'm told you're a massive Bruins fan. Is that true?
I like the Bruins, I like the Patriots, I like the Celtics, and I also like Man United.
Oh, you do as well. The reason I bring up the Bruins is because there's some interest in perhaps maybe you going to the NHL Players Association. Any truth to that, Secretary Walsh? There was a report from Politico this week.
I don't have any personal news to make today. Today I'm focused on a jobs report that has shown since the President Biden has taken office, 12.1 million people have either gone back to work or jobs been added to the economy. And certainly this is such an honor being Labor Secretary. And on a day like today, I feel even better about it being able to be on TV.
That sounds like you've got some news to make tomorrow.
I live my life a day at a time, so we'll see what happens.
Secretary Marty Walsh, I think we can read between the lines there. It's good to catch up, sir, as always. The Labour Secretary there, Marty Walsh. Coming up, more data coming in after today's very, very hot jobs number.
It could well be that, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth.
That conversation still ahead. Plus, iCapital's Anastasia Amoroso, PGIM's Mike Collins joining us, and Mike McKee's going to run back to the studio too. That's next. This is Bloomberg.
Times and global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union. Democracies should cooperate, and that they should understand that there is something we have in common: respect for the individual rights of men, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It could well be that, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth. Given what we know about the trajectory going forward, there's risk that employment will remain strong.
Neil Dutter of Renaissance Macro, 517,000 in the jobs report, 3.4% the unemployment rate. You've got to go back to May 1969, and the equity market down 0.7% in trying to stage a comeback. The Nasdaq down by 1.2% in the bond market. Yields much higher by 11 or 12 basis points to 422 on a 2-year. On a 10-year, up 10 basis points to 349. With us, I'm pleased to say, iCapital's Anastasia Amoroso, PGIM's Mike Collins. To the two of you, just a wow morning, Kay, with the market action of the year to date, and then this morning, off the back of a massive payrolls report. Anastasia, you said it, 3 silver linings. I imagine the data this morning backs that up.
Well, it certainly does. And John, I think I said it last time on Payrolls Friday that it was a soft landing type of a report. And this is yet again a soft landing type of a report, because we're seeing phenomenal job creation. We're seeing job openings that are still at 11 million. And as a result, these layoffs are not resulting in higher unemployment numbers. So as long as consumers are gainfully employed, that's going to prop up the economy. And I guess the other silver lining is that the wage inflation, 4.4%, a little bit higher than expected in last month year over year, but it's still sort of holding in this 4% range. So that's the silver lining, John. But I do worry that this challenges the view that Fed Chair said just a couple of days ago, which is that disinflation has started and it's soon going to start in the services part of the economy. I think it challenges that view, because if you have 11 million jobs out there and people are going to find jobs, that still creates some wage pressure, and 4% year-over-year wage growth is just not good enough for the Fed. So near term, I completely understand the market reaction, and frankly, we've come up a lot in a short period of time, so I'm not surprised to see this give back.
Mike Collins, your reaction?
Yeah, undoubtedly a strong number. Obviously we take single data points with a grain of salt, Jonathan, but if you look at the half a dozen or so last reports, the job growth is averaging, 350,000 or so a month. I mean, you cannot discount that. The sectors that we've seen the most growth in recently are the ones that, believe it or not, still have not gotten up to the level of total jobs since before the pandemic. Things like leisure and hospitality, healthcare, construction, services. We're still short jobs in those sectors. And as we all know, the services sector, the travel sector, has legs to it, right? I mean, this COVID rebound has legs, and it continues to boom. So this is a really good report for Main Street. This is a really good report for people. And you're seeing the movement in rates and stocks. They're still within the range of the last few days, so nothing dramatic. It's a good backdrop.
The president agrees with you. He said jobs are going up, inflation's going down. My economic plan is working. You'll hear from the president at 10:15 Eastern time, about 30 minutes from now. Mike, let's take the price action away. The market reaction to the payrolls report from an hour and 15 minutes ago. Let's park that, pretend it's not happening. When you look at that report this morning, does that raise the risk that this Fed needs to go further? Or do you take comfort from the fact that you can get unemployment dropping to 3.4% without wages accelerating?
Yeah, I mean, we've already seen a deceleration in the wage growth, right? From the mid to high fives down into the kind of mid fours. And I think a lot of that is the mix shift, right? You're seeing all the anecdotal evidence of these kind of high paying white collar jobs being eliminated from the tech and financial sectors and being replaced with those lower paying services jobs, Jonathan. So that naturally brings down the overall level of wages, which is good for the disinflationary story. But that doesn't mean individuals won't still have power, won't still have bargaining power to get higher wages. So if wage growth stays in the threes or at 4%, and inflation only comes down to 2.5 or 3, I don't think that's a bad world. Yeah, that's a world where the funds rate has to stay above 2.5 or 3. So maybe the funds rate lands, at 4% for the next few years. That is not a bad world for investors.
We've had a year of gains for investors, a year of gains in a month. Anastasia, it's what now? What now?
Well, what now? I do think that at this very moment, we are due for some sort of pullback and consolidation because, if you asked me 2 or 3 weeks ago, I would have said, well, we're not yet at technically overstretched levels. And, maybe this market has more room to run, but we are approaching overbought levels certainly on tech and on other parts of the market. And the risk that I think these markets may need to appreciate is there's a risk that what the part of inflation that it has in fact been transitory is the goods inflation, the supply chain bottlenecks. It seems like it took longer to transition, but it seems like it is transitioning away. And that's why the headline inflation is falling as food, fuel, and durable goods prices are falling. But there is a risk that I don't think market participants are really focused on, that maybe there's a secular inflation narrative that is more sticky, and that is wages. If we do continue to see the strength in the labor market, wages don't go down to 2%, maybe they stay at 4%, that's a problem. And we may end up in a position where, especially as China reopens, and that puts pressure on, the goods sector inflation again, especially via energy, and then we still have this sticky services inflation, then maybe we're not, in fact, on the path to 2%. So that's the risk that I worry about, that the markets sort of need to price in near term. So the view is, yes, there are silver linings. Yes, there's reasons to be more constructive on stocks this year, but it's really difficult to see us go above 4,200 until we convincingly get rid of inflation.
Given what you just said about inflation and the backdrop and what may materialize later in the year, I'll get my words out. It's been a long morning. Anastasia, does that shape your view on what sector you want to be in? Would you fade the leadership in tech you've seen so far this year?
Well, again, it's all about the entry point into the sectors that we like, which I do like semiconductors, I like software, I like real estate. Now that they've run up, in the case of semiconductors, 15% or so year to date, I wouldn't tell you that now is the time to add to them right now. But as things pull back, the type of sectors you do want to buy are the ones that are well positioned for the Fed funds rate to peak and for inflation to sequentially come down. And that brings me to semis. I really like that space because valuations have been cut relative to last year. And semis are very highly correlated with manufacturing PMIs. Well, the PMI data went from 60 to now 46. So we've seen a bulk of the correction in manufacturing. And for that reason, I think we might have seen a bulk of the correction in semiconductors. And semis, by the way, have the sensitivity you want to falling inflation. So I think there's a lot supporting the sector, and especially the secular semis. It's not about memory, it's not about PCs and smartphones, but it's about artificial intelligence, for example. So that's where I would focus within the markets right now. But I would do so once the semi stocks correct just a little here.
Mike Collins, that's equities. Let's finish on credit. High yield spreads have tightened so much, 386 basis points now, Mike. I asked this question of Rick Reeder earlier on. When you started the year, it was buy fixed income. It looked great. There were big yields. Is the same true now?
Yeah, Jonathan, I think in high quality bonds, to Rick's point, we're kind of in agreement with him on this one. There's so much value in high quality interest rates, high quality spreads, but I don't think you're getting paid enough yet to go down in quality aggressively, right? Yeah, the high yield market's yielding, 8 and change, but you do lose some of that to defaults, and we know default rates are going to go up. These higher interest rates, as companies have to start refinancing their debt profiles, and consumers, right, and real estate investors, that is still going to bite. People talk about these lags of monetary policy, and I think the longer that funds rate stays around 5, it really does start to bite. So you're going to see more weakness later in the year. Yeah, maybe it's not the hard landing, and I've been in that kind of soft landing, mild recession camp all along, and it seems like that scenario is really playing out here. So it's not a disaster for high yield, but at these levels, it's not really attractive. But it's a year where you buy on the weakness. You kind of hope for spreads to widen, and you buy, because now you have the Fed potentially behind you. To Rick's point again, last year you went from a year where the funds rate went from 0 to 5.
Yep.
That's a year where you kind of sell into rallies. This year, they have 500 basis points of capacity to support the economy if it does weaken. That's a really good position to be in.
Mike Collins, this was great, as always, alongside Anastasia Amoroso. To the both of you, thank you. Bit of news out of Washington. The Biden administration had been weighing whether to postpone or cancel an upcoming trip of Secretary Blinken to China, given the latest news over the last 24 hours that the US had been detecting a Chinese surveillance balloon over the United States. We're getting some news just now. The US to postpone Blinken's visit to China over that spy balloon. So that's the latest news there. One more piece of news. We always knew this. The president watches Bloomberg surveillance. Mike McKee saw that hit of yours at about 8:30 Eastern time, retweeted it and said jobs are going up, inflation is going down, and my economic plan is working.
Very flattered. I guess you can credit the president because the president has to take the blame when things go bad. So, a lot of this has to do with the spirit of the American people, but he can grow today. John, we did have a little economic news while you were talking to Mike and Anastasia. The S&P Global U.S. Services PMI comes in a little higher, 46.8. The composite comes in at 46.8. Those are up 2 ticks. The next thing is ISM, top of the hour.
Looking forward to it. Mike McKee, thank you. Your trading diary up next.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
26 minutes in, price action lower. Here's the trading diary. Coming up, ISM Services top of the hour. President Biden, 10:15 Eastern. Fed speak returns with President Mary Daly on deck, plus Fed Chair Jay Powell speaking next Tuesday, along with President Biden's State of the Union address. From New York City, what a morning. Have a wonderful weekend. This was the Countdown to the Open. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain while come. This is a 3.
As the economic picture does.
Is it the okay is getting ready to make a decision.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2-branch hearing otherwise. For not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Benegold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
the threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter. It's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers. One of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa! Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
the GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.